everybody made it here safe and sound. It's kind of crazy out there today, so be careful when you leave. Just be ready for you guys to stay. Before we go on the record, just some housekeeping matters to go over. I'd like to confirm that their SUV submitted Exhibit G as an additional exhibit. Is that correct?
That's correct.
And the appellant has no additional exhibits to submit.
That's right.
And a reminder that appellant will go first to present your argument and your testimony, and then FTE will go to present its in chief, and then appellant will have 5 minutes on the rebuttal. Another reminder to speak clearly and slowly and not over each other for the benefit of our hearing recorder. Any questions before we get started?
No.
Questions? We're opening the record in the appeal of Ashraf, Ibrahim, and Abdelkerim for the Office of Tax Appeals. The case number is 1801-1787. The hearing is being convened in Van Nuys on October 28, 2019 at 10:02 a.m. Today's case is being heard and decided equally by a panel of 3 judges. My name is Linda Chang, and I will be acting as a lead judge for the purposes of conducting this hearing. On the panel today with me are Judges Wing Dang and Richard Dang. Will the parties please introduce yourselves on the record? Starting with the phone.
Eliani Polis on behalf of Mr. Abdelkerim, seated to my left.
Ashraf, Ibrahim, Abdelkerim.
Welcome. To be?
Megan McEvely on behalf of respondent, and to my left, Maria Brosterhouse.
Welcome. Thank you. Okay. The only issue on appeal is whether appellant has shown a reasonable cause for the abatement of the late filing penalty for tax year 2014. Is that still correct?
Yes.
Yes.
Prior to the hearings, the parties have agreed that FTB will introduce exhibits A through G as part of their evidence, and the appellant will introduce exhibits 1 through 3 as part of their evidence. Any objections to that, appellant?
No objection.
No objections. Thank you.
Okay, so those exhibits, as stated, will be marked as evidence and admitted into the record. Okay, Ms. Polis, you will have 25 minutes to present your case, including testimony by your client. Mr. Abdelkerim, you're testifying today?
Yes.
Will you please stand up and so I can swear you in?
Yes.
Do you swear or affirm to tell the truth, the whole truth, and nothing but the truth?
Yes.
Please see this. Begin when you're ready.
Right. This is an abatement of a late filing penalty, specifically a delinquency penalty in the amount of $3,816.50. Mr. Abdelkerim has reasonable cause to abate this penalty because he reasonably relied on a tax preparer, Mr. Rind, his CPA, for advice. Mr. Rind informed him of a federal tax extension. They have a history together of discussing both state and federal taxes. However, Mr. Rind and Mr. Abdelkerim are not in a specific habit of technically talking about the specifics of state taxes. Mr. Abdelkerim is not a sophisticated tax preparer, he is an average taxpayer. As I said before, Mr. Rind was comfortable handling the state tax portion of Mr. Abdelkerim's taxes in the past, as well as the federal taxes, and they had talked of the federal extension. Mr. Abdelkerim didn't rely on Mr. Rind to file the taxes, but to advise him about both state and federal taxes, as they have in years past. Now, Mr. Rind's omission in discussing the extension for state taxes is advice. Mr. Abdelkerim relied on that omission and therefore did not ask for an extension in his state taxes. The average taxpayer would rely on silence or an omission as advice when dealing with his CPA that he has known for years. At this time, I would like to ask for the testimony of Mr. Abdelkerim. Mr. Abdelkerim, please describe your relationship with Mr. Rind.
So, Mr. Ryan was my, Mr. Ryan was my CPA from 2010 and through this tax year. He had filed my federal and state taxes, so for 4 consecutive years prior to this tax return. That would describe our relationship.
And what is the nature of your discussions with Mr. Rind?
So we will periodically meet to discuss the federal and state tax returns. Generally, he'll ask for information from me in terms of my income. I'm a physician, so I work with in that year and kind of previously, since I finished my medical training, the emergency physician groups that I work with require me to have a corporation. So I had a corporation, and I was the sole employee of that corporation. Because of the complexity of that situation, I had an accountant filing my federal and state tax returns from the beginning of from 2007 essentially, but he was my accountant from 2010. So we would typically meet, and I would present him information. We would have discussions regarding my tax returns. He would prepare an initial return. I would review it, and then once I had reviewed it, then we would move towards submitting it, and he would assist me with that.
Nothing further at this time.
FTB, any questions for our appellant?
No.
Panel, any questions? FTB, Rob?
Thank you for your time today, panel. The sole issue in this case is whether appellant has established reasonable cause to support abatement of the late filing penalty. The respondent's imposition of the penalty is presumed correct unless appellant can show that the failure to file his 2014 tax return was due to reasonable cause and not willful neglect. Appellant must provide credible and competent evidence that his failure to timely file occurred despite the exercise of ordinary business care and prudence. Appellant has a personal, non-delegable duty to file his tax return timely. As we've heard here today, appellant has testified that he relied on his CPA to provide him advice. And in the record, it indicated that he received advice to file his federal return late by the extension, federal extension date, in order to determine whether he could qualify for some federal exclusions. Nothing in the record and nothing stated today, nor is there any supporting evidence, indicates or supports that appellant actually asked for advice with respect to his California tax obligations, or that he received advice from his CPA. His testimony today admitted that he received advice in 4 consecutive tax years from the same CPA. He filed prior tax returns in California. A reasonable person would have asked his CPA for advice in 2014 because he filed his California tax returns in the prior 3 years. Now this leads me to the issue of reliance. As the U.S. v. Boyle case, which has been adopted and applied in recent presidential cases such as the appeal of Pareca through the Office of Tax Appeals, the failure to make a timely filing of a tax return is not excused by the taxpayer's reliance on an agent, and such reliance is not reasonable cause. It is well settled that one does not have to be a tax expert or have a sophisticated understanding of the tax laws to know that they need to file timely. Reasonable cause may exist, true, if the tax provider provides advice on a substantive tax law with respect to the filing of his California tax return. Appellant has provided no evidence to establish that he asked for or received advice of a substantive error in the area of substantive tax law with respect to the filing of his 2014 tax return. This leads me to the letter provided by Mr. Rind, his CPA, which is Appellant Exhibit 3. There's nothing in that letter that indicates, again, that he asked for or received advice from the CPA. The CPA only states that he provided advice with respect to his federal obligations. Now, to the extension that he received for his federal return, the record reflects that appellant thought he had till January 30th to file his federal return. The IMF in Exhibit G, appellant's respondent's Exhibit G, indicates that he had until October 15th, 2015. Respondent provides an automatic extension of 6 months. And for those living abroad on April 15th, such as appellant, he would have received another 2 months. So had he filed his return by June 15th, 2015, it would have been timely. But in this case, although the record reflects he thought he had until January 30th, 2016 to file his return, he didn't file his California return until March 1st, 2016, and has provided no competent or credible evidence to establish why that delay constitutes reasonable cause. Now, the record indicates in his protest letter, which is appellant's appellant's Exhibit 1, he indicates, "I'm sorry for making this mistake." To the extent that his claim in the record is that he made a mistake and this misunderstanding constitutes reasonable cause, it is well settled that mistake in and of itself is not enough to establish reasonable cause. In closing, appellant has not overcome the presumption of correctness attached to the penalty. He has not provided credible and competent evidence that his failure to timely file occurred despite the exercise of ordinary business care and prudence. He has not established that the failure to timely file was due to reasonable cause. Based on the controlling law, the evidence of the record, and the testimony we heard here today, respondent requests that its action be sustained, and I'm open to any questions should you have any.
Thank you. Any questions?
Thank you. No questions.
Ms. Polish, you have 5 minutes on the phone.
Yes. Now, Mr. Abdelkerim relied on a CPA for expert tax advice, and this is reasonable cause. He is not neglectful. He is an ordinary and reasonable person.
Can you put the mic on? Thank you.
He did not neglect his duty, but rather acted with ordinary and reasonable business prudence by relying on a CPA. Now, the CPA, Mr. Ryan's omission, constituted advice, especially when talking about extensions with an average taxpayer. Now, a reasonably prudent business person who is an average taxpayer wouldn't challenge a CPA and wouldn't believe that when a CPA gives advice as to a state tax return, that that advice is incomplete. He would believe that that advice is full and complete and that he can reasonably rely on that. Now, as per U.S. v. Boyle, Mr. Abdelkerim didn't rely on a CPA to just file the taxes. He relied on a CPA for expert advice, and it's that reliance that constitutes reasonable cause. Thank you.
Thank you. Questions? Okay. Seeing that there are no questions, we are ready to close the record and submit this case for consideration. Mr. Abdelkerim, did you have any questions?
Yeah, can I respond to what was said?
Yes. Yes, of course.
Okay. In this instance, we did discuss that filing my state tax return just as we had the 4 previous years. In fact, there are on my review of my communications with my accountant, I don't recall the specific emails that were sent, but on my review of them, there were multiple emails sent that where we were discussing my state tax returns, and he also helped me with filing. There's I guess a California non-resident form when you move and establish residence abroad, so he helped me file that in early 2015. My understanding when we had just discussed the extension, which was for the purposes of, was more for the purposes of my federal tax return, that the extension was for all of my returns. And it wasn't really until wasn't until much later, and I can't, I'm trying to remember the time that I became aware of this penalty, but that was, I think, in like mid-2016. That's when I first became aware that there was even like an issue regarding my late filing. So she had mentioned that I filed in March. That delay was related to my accountant telling me that was the time to file. And I don't know why he had made that determination. There were preliminary preparations of my state tax return for that year that were done in, I think, April or May of 2015. So I'm not sure why he delayed until essentially 10 to 11 months later in terms of actually preparing to submit or preparing the documents for me to submit for my state tax return. I did acknowledge that it was a mistake, and I feel that, you know, in retrospect, it's obvious to me that this should have been done earlier, and I really wish that it had been done earlier. I think the reason that I didn't do this on time was because I was relying on his advice, and I thought that we had filed an extension and that we were not in delinquency, essentially, is I guess what I would have to say.
Understood.
Thank you.
Can you elaborate a little bit on maybe the filling out of the return? Were you waiting on documents? Were you have the information? Were you waiting on information in some way before you could file your state tax return?
No, I wasn't waiting on any specific information. As I mentioned, so I had provided him in April of 2015. I had provided him with all the information that he would need to complete my tax return. He did that, and I reviewed it, and then there were some. I don't believe with respect to the state tax return there was any kind of revisions, but regarding my corporate tax return there was a little bit of back and forth to kind of finalize that. But in terms of the state tax return, I don't believe that there were any corrections. Like had he said to me in April when he had all the information, okay, let's go ahead and submit it, that would have been submitted. It just was not, like I said, I don't know why there was a delay, but it wasn't related to any additional information that I need to provide for further revisions of what he had prepared initially.
Okay, thank you.
If there's nothing further from either party, we will now be closing the record, and the case is submitted for decision.
Does FDB have an opportunity to respond to what he just said?
If you wish, sure.
Much of what he said, including reference to emails, is unsupported and uncorroborated. So if there were emails, there was evidence of actual advice or being asked, where he asked the advice, these things that his recent testimony referred to aren't in the record. And without supporting evidence, they're just unsupported statements, unfortunately. They weren't provided, no such emails or conversations or even phone records were provided to respondent for consideration. Thank you.
Okay, now we're really closing the record, and the case is being submitted for a decision. The panel will meet and discuss the case following the hearing, and we will strive to issue a written decision within 100 days of today. The hearing is now adjourned, and we will be taking a 10-minute break until the next hearing.
Thank you for your time.
No.
Good morning, and welcome to everybody for coming today. I'm John Johnson. I'll be the lead ALJ for this hearing. With me today are Judge Gast and Judge Ted. Can you get the parties to introduce themselves? We'll start with appellants.
Yes, Your Honor. Good morning. I'm Hector Perez, the attorney for, one of the attorneys for the Lindseys. This is Dr. David Lindsey and Mrs. Loryn Lindsey, the taxpayer. And my co-counsel is Mr. William K. Jewerly, also an attorney representing the Lindseys.
All right, thank you. And we'll try to address any questions of appellants. We'll just come to your direction. We may be able to sort of on a testimony questions like that. We'll be specific as to addressing questions too. And franchise tax board?
Good morning. I'm Sonia Woodruff, and with me today is Lindsey Parker for the Franchise Tax Board.
Thank you. And same thing, we'll might address questions as responding to franchise tax board, but we'll try to say FTB, or might address Ms. Woodruff and Ms. Parker individually questions. We do have a few items to go over before we go on the record. Pre-hearing conference was held in this matter, and the process of this hearing was generally outlined in the minutes and orders that was sent to both parties. We'll go over that in a little more detail and also do some housekeeping issues. The first thing I wanted to cover is the issue on appeal. As I have it stated here, is whether appellants have shown error in the Franchise Tax Board proposed assessment of additional tax, which is based on unreported gain from the sale of a residential property. Does that sound accurate to appellants?
Yes.
Yes, sir.
And Franchise Tax Board?
Yes.
Thank you. And let me ask appellants, does the gain on the sale of the properties also account for the 2004 and 2005 proposed assessments, or are those related to deductions and other matters?
Those are other matters.
Okay, and those have been resolved already by the parties, correct?
Yes.
Okay. Is that?
That's correct.
Thank you. I know for 2003 is also a late filing penalty and an accuracy-related penalty. And I believe in appellants on your brief, it was back in 2015, but you did state that you requested the penalties would be recomputed. So you're not looking to address the penalties separately as different arguments. It's only that they would be recalculated based on the main issue.
That's correct.
Thank you. So I do have a few concessions and stipulations that I've gathered from the record. Franchise Tax Board, you submitted on 10/24 of this month revised amounts at issue.
That's correct.
I'll read those once we go on the record. Franchise Tax Board also abated the failure to furnish information penalties for each year at issue. Appellants have conceded the investment interest expense deductions and the casualty theft loss expense deductions.
Yes.
And the parties have stipulated to the home mortgage interest expense deductions for all 3 years, and I can read those once we go on the record.
Yes, that's correct.
And just so I'm straight, appellants, you're claiming the basis in the property at issue of $1,424,526. Is that correct? Does that sound accurate?
No, Your Honor. Did you say adjusted basis?
Basis in the property, I was going off of, I believe, your latest submissions. Well, if it's different, I won't read those into the record, and I'll let you introduce your facts and arguments once you get on the record. And sort of a foundational question, I don't know if this is actually resolved or not, but Franchise Tax Board, are you disputing the sale of 1/2 interest in the property to Marbell Holdings in 1996?
No, we're not.
Okay, so that's a stipulated fact that that sale did happen.
Well, yes, it was a sale that they benefited from, but they didn't actually sell their entire interest. So there are some issues in dispute there, so.
Okay, good to know. I'll leave that off with my stipulations then, so it can be discussed by the parties. Exhibits from the briefs. I know we have two documents that were handed to us, two sets of documents. But previous to this, we had exhibits 1 through 33 from appellants. And then Franchise Tax Board had A through Z, A1 to Z1, A2 to Z2, A3 to Z3, A4 to Z4, A5 to L5, and A6 to J6. And that's what we have submitted prior to today. Is that accurate?
That sounds right.
Okay. I understand the appellant has objections. We'll handle that on the record so that we get recorded. And as far as the submissions today, Franchise Tax Board, I believe the packet of hearing exhibits you've handed us today is already in the record. Is that correct?
Yes, that's correct. Those are selected exhibits from the record.
Okay, we'll not treat that as new evidence then, just as reference aids.
Yes.
And appellants, you have submitted 2 pages of documents. Does this constitute new evidence you want in the record, or just hearing aids?
It's just a hearing aid, Your Honor. It's a summary of what is expected to be covered. So it's for assistance, a review, and your convenience.
Great, thank you, very helpful. As far as witnesses, Franchise Tax Board, you have no witnesses today, correct?
No witnesses.
And appellants, I know you intended on Mr. and Ms. Lindsey to testify today. Is that still true?
Yes, sir.
Any other witnesses that you'll have?
No.
So in accordance with the conference minutes and orders, we had 30 minutes allocated for appellants, and that'll be for your testimonies and arguments. It'll be kind of cumulative, 30 minutes for all. Let me ask, do you know if Mr. and Ms. Lindsey are going to testify as a narrative or as answer questions, or are they going to read prepared statements?
Your Honor, they have prepared declarations with attached exhibits already under the penalties of perjury. We essentially want to make sure that they have reviewed that it's still under the penalty of perjury, if they have any changes, and then we would like to submit that as part of the record, Your Honor. Subject, of course, to cross-examination or any questions that Your Honors may have.
Any questions about that, MTV?
I don't believe so. I may wish to cross-examine or ask any questions.
Of course. And I know you have 30 minutes total for your presentation. It wasn't sort of broken down in any kind of format. What I'd like to do is when we do testimony, that we have one individual testify, and then we'll allow FTB to ask questions, and the panel might have questions, and then the other individual can testify and questions again. And we'll come back to you, of course, so you can ask any follow-up questions after any questions from MTB or the panel.
That's fine.
After appellants' arguments and testimony, we'll have 30 minutes for Franchise Tax Board, and then we'll come back for 10 minutes on appellants for rebuttal. At that point, the panel may ask any questions about the arguments of the parties that they have any. That will wrap up our day. Do we have any questions before we start going on the record?
Your Honor, just primarily clarification. This is the first time that we've been here, although we've been practicing for some time. We want to make sure that we leave nothing off the record, because this is their first chance to be heard since I first filed the paper in 2007, providing everything that they wanted. So I want to make sure that everything that we've submitted, additionally, again, as exhibits in the index list, is covered and is in the record. And of course, I'm merely asking for assistance in the event that there's a technicality or a rule of practice that I may not be familiar with that we are missing, because I want to make sure that everything that we're providing is on the record, because we have already extensively briefed over and over and provided with exhibits, and for the pre-conference hearing statement or afterwards, we were asked to resubmit everything again in a different format. I presume that was for the convenience of your honors, but I want to make sure that all of that is
Right, that's correct. There's more ministerial logistics kind of to make sure that we had everything in order that we can reference it, so that you're, as you have in your notes here, you can say, you know, item number 22 and not have us wondering which exhibit B it might be. So everything that you submitted, unless there's objections that are sustained, will be amended to the record. So your exhibits 1 through 33. And you might have 2 additional declarations that you're going to exhibit or submit today as well.
They are actually already part of the record.
Okay.
They are OTA exhibit number 1 and OTA exhibit number 16, the declarations of Dr. Lindsey number 1 and the declaration of Loryn Lindsey number 16.
Okay, thank you, that helps. Let me make sure my panel is ready to go.
Now, Your Honor said that you were going to permit us to make sure that the objections were noted. We had filed objections to the FTV exhibits, and we did not hear a response. But they were relevant objections, and if it's going to go on the record, Your Honor, I'd like to augment that and basically say not only relevance, but lack of foundation on a lot of these exhibits.
Sure, and I'll save those when we're on record to make sure that we get everything recorded for you.
That's fine.
But I definitely have your objection pulled up in front of you right now, so
Thank you very much.
ready to go.
Okay.
Any final questions from FTV?
No.
Next time, Chris, ready? Let's go on the record. This is the appeal of David Lindsey and Loryn Lindsey, OTA case number 18012-098. It is 10:42 a.m. on October 28th, 2019, here in lovely Van Nuys, California. I'm the lead ALJ for this hearing, John O. Johnson. Let me say good morning to my fellow co-panelists today. Good morning, Judge Guys. Good morning, Judge Day. While I'm the lead for the purposes of conducting this hearing, the panel, 3 of us, will make a decision on appeal. We have read the briefs, we have the arguments, and we've in the briefs, and we've also examined the evidence as well. We fully respect the importance of the decision being made on this appeal. We know certainly in this case it's taken a long time to get to this point. We appreciate the effort that everyone's put forth. Let me have the parties introduce themselves and who they represent, starting with the appellant.
Yes, Your Honor. Hector Perez and William K. Shipley on behalf of Dr. David Lindsey and Loryn Lindsey.
Your Honor, we'd like to call...
Oh, sorry. I was making sure you introduced everybody. Okay. Let me go to the Franchise Tax Board and you can introduce yourselves.
Good morning, I'm Sonia Woodruff, and I'm here with Nancy Parker today for the Franchise Tax Board.
Thank you. The primary issue we have on appeal is whether appellants have shown error in the Franchise Tax Board's proposed assessment of additional tax, which is based on unreported gain from the sale of residential property. Proposed assessments are at issue for the 2003, 2004, and 2005 tax years. A late filing penalty and an accuracy-related penalty were also proposed for the 2003 tax year. Next, we'll cover the exhibits. Appellants have exhibits 1 through 33. Franchise Tax Board, any objections to those exhibits?
No objections.
Thank you. Franchise Tax Board has exhibits, and I'll read them, A through Z, A1 through Z1, A2 through Z2, A3 through Z3, A4 through Z4, A5 through L5, and A6 through J6. And now, appellants, you have submitted objections to some of those exhibits. If you'd like, I can read your objections of which exhibits.
Your Honor, please go ahead.
Exhibits A through T, pages 7 through 120 of Exhibit W, Exhibits A1 through F1, Exhibits T1 through X1, Exhibits A2 through L5, and Appendices A through J. Does that sound accurate?
Yes, Your Honor. In addition to that, we would also object to the documents as lack of foundation, meaning there's no hearsay exception on which we could examine those documents. For example, there is a revenue agent's report that was obtained wherein a lot of allegations were made. We expected those allegations to have been resolved in an IRS audit, and that's why one of the reasons why the case was postponed. The IRS audit came about, we went before the tax court, and the IRS conceded all of the issues. So as to all of the allegations that are set forth there, they would be objectionable hearsay because we could not examine the revenue agent, for example, and ask and inquire about all of the statements that she made in that report, for example. So it's basically lack of foundation and hearsay.
In addition to a lack of relevancy to
Yes.
the state objection. And the pre-hearing conference minutes order set up a system for objections and allow the other party a chance to reply. I think your objections came in a little bit later than anticipated in the pre-hearing conference minutes and orders, so there wasn't the proper time for the Franchise Tax Board to submit a written response. But Franchise Tax Board would like to reply now.
Sure, we would. So all of the evidence that we've submitted is directly relevant to the question of whether or not the appellants are entitled to reduce their gain. And so we would submit that, you allow in the evidence because it is directly relevant to the issues.
Thank you. As background information, the Office of Tax Appeals Regulation 30214E states that the California Rules of Evidence do not apply to proceedings, including oral hearings before the OTA. And while the panel may use the rules of evidence when evaluating what weight to give evidence presented in a proceeding before OTA, all relevant evidence shall be admitted. This treatment is consistent with the relaxation of evidentiary rules applicable to administrative hearings, as stated in the California Supreme Court decision of Lake v. Reed. The site is 16 Cal 448. Per our regulations in that same section, the lead ALJ has discretion to exclude evidence if it is determined that the probative value of the specific evidence is substantially outweighed by the probability that its inclusion would necessitate an undue consumption of time. Appellants have objected to a large amount of Franchise Tax Board's exhibits, as we just read, asserting that they are not relevant and also asserting a lack of foundation at this point. Including in the exhibits that were objected to are some exhibits such as appellant's original and amended returns for the years at issue. These appear to us to be entirely relevant to the proceeding before us. And although appellants appear to not believe generally that most documents related to years after 1993 can have relevance, we find otherwise. As such, we are overruling appellant's objections. Appellants are still free to argue that certain exhibits should not be given much probative value, of course, but they will be admitted into the record as we do see some relevancy to them. Accordingly, all exhibits from both parties are admitted as evidence into the record. I'd like to go over stipulations. FTB has revised the amount at issue, providing for 2003 an additional tax amount of $157,709, a late filing penalty of $38,885.75, an accuracy-related penalty of $30,176.20, an additional tax for 2004 of $6,175, and additional tax for 2005 of $1,302. Franchise Tax Board, is that accurate?
That's correct, although I think that 2004 and 2005 may not be in dispute.
Thank you. In addition, Franchise Tax Board had originally proposed a failure to furnish information penalty for each year, and that has been evaded. Appellants have conceded the investment interest expense deductions and casualty theft loss expense deductions. Parties have stipulated to home mortgage interest expense deduction of $76,046 for 2003, $42,650 for 2004, and $50,724 for 2004. Does that sound accurate?
The figure again for 2003.
2003 home mortgage interest expense deduction was $76,046. With that, I have no further preliminary matters. I'm ready to begin with the parties' arguments. We're going to start with the appellants who have 30 minutes to deliver their arguments and testimony. Do you think you'll start immediately with testimony, or will you start with arguments?
Your Honor, at a start, we can speak to the taxpayers themselves about their declarations. They're already in the record, and that should shorten the presentation here. We initially wanted to advise the panel that our view is more narrow than the issue being what is the gain. Our issue is, we believe the issue is whether or not there is satisfactory evidence that improvements made to their residence after they purchased it were paid for by the taxpayers. And well, that's a kind of a subset of the main issue that you pronounced earlier. That's the only issue that we're going to address.
Okay. Let me go ahead and start, since it sounds like you might go into some questions of the taxpayers and have them attest to facts. Let me go ahead and swear them both in first, and then keep moving along. Please stand. Okay. Raise your right hand. And do you swear or affirm to tell the truth, the whole truth, and nothing but the truth?
I do.
Thank you. And depending on how we proceed, if it is sort of just argument and testimony mixed in, we might wait until the end to allow franchise tax board extra questions, if that's okay.
That's fine.
Okay. You do have 30 minutes cumulative, so please begin when you are ready.
Thank you. I'd like to question Dr. Lindsey, if I might. Dr. Lindsey, did you earlier provide in this proceeding a declaration under penalties of perjury regarding this case?
I did.
And since that time, and before this hearing, have you had an opportunity to review that declaration and more carefully to see if you needed to make any changes?
I have.
And you need to make any changes to that declaration?
No, sir.
The declaration that you filed in this case was accompanied with a number of exhibits. Have you also reviewed those exhibits?
Yes, I have.
And do you have any changes you want to make to those exhibits that you've submitted, or any revisions of any sort to those exhibits?
No, sir.
Okay. Do you have the declaration or a copy of the declaration? I have a couple of specific questions that I'd like to ask, and that should conclude your testimony. Can you find as an exhibit to your declaration, Exhibit D, or it's now renumbered as number 6, Exhibit D. For the panel, this is our hearing exhibit number 6.
You said D or B was the board?
D, yes.
D, sorry. Yes, sir.
Right. Now that's a two-page document.
Yes.
Take a look at page number 2 of that document.
Yes, sir.
Now, if you notice, about a third of the way down, this is a hearing officer report. A third of the way down, it talks about you are owning a corporation, and then discusses a specific check. Check dated 1998 for $3,000. You see where that is?
Yes, sir.
Have you seen that actual check?
Yes, sir.
And that is a check that the hearing officer thinks possibly is a corporate check. Is it a check done on a corporate account?
No, it is not.
And on the face of the check, does it say, as the hearing officer indicates, your name followed by MD?
Yes, it does.
And you maintain a personal bank account at this particular bank, is that correct?
Yes, I did.
And after reviewing this specific check that's specified in the hearing officer, can you tell the panel whether or not that is a check going on a personal or on a corporate account?
That is a check drawn on a personal line of credit.
All right, thank you. Now, I'd like to hand you, before we finish, I'd like to hand you the OTA exhibit number 23, two-page document. And what is that document?
This is a letter from our accountant discussing, architect. Specifically, I had some concerns about discharges.
Was this an accountant that wrote you a letter?
No, this is the Peter Harmon, who is our architect for the revision of our home.
All right.
Planning.
And why did he write you this letter? Do you know?
Yes, I got a little heated with him because I was concerned about the costs. So specifically, I said to him, you need to justify the charges. And this was his response to going through the billing, to show me what he was doing, what it cost, and why.
Now, the second page of that document is what?
These are the bills that he submitted to Loryn and I for his services that we paid.
Now, were those services paid for out of personal funds?
Yes, they were. Combination of salary I received and credit line for construction.
Back, please. Your Honors, that constitutes the testimony of Dr. Lindsey.
Thank you. Franchise Tax Board, did you want to ask questions now or hopefully?
I actually don't think if that is all the testimony, I don't think I have any questions.
Okay, that sounds good. And just a reminder, if we have a microphone, talk into it. If we don't have a microphone, try to be extra loud.
Next, I'd like to hear from Loryn Lindsey. Ms. Lindsey, during the life of this case, the long life of this case, did you prepare and submit for consideration a declaration?
Yes, I did.
And was it under the penalties of perjury?
Yes, it was.
And did you submit with that declaration any exhibit?
Yes, I did.
And what was the exhibit?
With my ledger of expenses.
And is it your declaration that and your testimony that the payments in question to the architect and to the construction company were made by you personally?
Yes.
And is it also your testimony that the payments were made exclusively from personal accounts?
Yes, they were.
And that no payment of any sort, either to the architect or to the construction company, for the work they did in 1991 and 92 was paid by anyone else?
No, just our personal funds.
Thank you.
Is that it?
We submit that as the testimony of Loryn.
And Franchise Tax Board, do you have any questions for him?
I also do not have any questions.
Thank you. You can proceed with your argument. Please make sure you have the microphone close to you.
Yeah, Your argument, Your Honor, this case is a case that got off to kind of an unusual start, and that is when a single check written several years after all these improvements were made, was detected by the auditor and or the hearing officer, and for some reason, because Dr. Lindsey put the words MD next to his name, and because the account was located at the same address where he had his business, not unrealistic, I'm saying, concluded that that might be a payment made by the corporation rather than by Dr. Lindsey personally. And that, we believe, was incorrect. And Dr. Lindsey has so testified that check was not a corporate check. In addition to the fact that it was dated several years later, it was not made payable to either of the two people involved in this case. That is, not to the architect and not to the contractor, Young and Burke. And it is several years later, and it, on its face, appears to be a check for something other than improvements. It appears to be a pool. But that, I think, was the genesis of this notion that the Lindseys did not pay for all the improvements that we requested be recognized. But they did not pay them with personal funds. So there is no question in this case that a massive amount of improvements were made. We have exhibits here that will clearly demonstrate that there were improvements made. The two individuals in charge of making those improvements say they were made and say they were paid for. And both mention Dr. and Mrs. Lindsey by name when saying who paid for. So I don't believe the Franchise Tax Board is arguing that these improvements were not made, and I don't believe that they are arguing that the people who made the improvements were not paid. The argument seems to be the provenance of the funds that were used to pay these two people. And I think it's pretty clear in this case, although the evidence is not as terrific as a box of canceled checks would be, I think the evidence here establishes sufficiently that these expenditures were made by the Lindseys utilizing personal funds. In addition to Dr. Lindsey's dispute regarding this one particular check, there are other things that we believe support this notion that the Lindseys paid for these with their personal funds. At one time, according to exhibit number 4, that's in the hearing exhibit number 4, the hearing officer speaks of a $750,000 loan that was obtained by Dr. Lindsey and his wife from a private lender. And Dr. Lindsey's declaration acknowledges that. And taking on a $750,000 of debt seems inconsistent with the notion that somebody else is paying for all these improvements. In addition, our exhibit number 12, which reflects recorded loan records, show how the recorded debt, the Lindseys' recorded debt, grew from $900,000 in late 1990 to $1,675,000 by early 1993. A huge increase in their reported personal loan liability. You combine that with their $750,000 of unreported personal debt, you can see that there is a huge increase in personal debt at the same time that these improvements had to be paid for. And Dr. Lindsey, in his declaration, testifies that those were the source of his payments to the architect and to the building contractor. There's another letter. There's in addition hearing exhibit number 10, which is a letter that the building contractor wrote to the Franchise Tax Board Council, and wrote under the penalties of perjury that all payments to Young and Burton Incorporated were made by the clients, David and Loryn Lindsey. Mr. Burton also provided at Exhibit 8 a job cost analysis which places the total costs and money received for these improvements during 1991 and 92 at $1,586,816, and further states in his handwritten notation that the monies were received from David and Loryn Lindsey for that work. And in addition, Dr. Lindsey and I just discussed exhibit number 23, which is a letter to Dr. Lindsey from the architect trying to respond to Dr. Lindsey's concerns, the letter recites, about the fees that was being charged. Obviously, or hopefully, we believe the panel will conclude that if Dr. Lindsey was not using his personal funds to pay for these improvements, we wouldn't have any concerns. Thank you.
Thank you. Franchise Tax Board, you have 30 minutes if you're ready.
Thank you. Good morning, Judge Johnson, Judge Gast, and Judge Tay. The only remaining issue in this case is how much gain appellants must recognize from the sale, the 2003 sale of their Lafayette home. Appellants concede all but approximately $1.6 million, which they claim to have spent on capital improvements to the home. The facts of this case, however, cannot support any reductions to the gain for two main reasons. First, appellants sold a one-half interest in their home twice. They sold one half of the residence in 1996 for approximately $1 million, and then they sold the entire residence, 100% of it, in 2003 for $3.6 million. They applied one half of the basis to the sale in 1996, which is why they argue they had no gain to recognize in that year. And as a result, they may only apply the remaining one half of the basis in 2003 when they sold the entire property, which would amount to $1.4 million. Respondent has already allowed nearly that amount, or $1.26 million of basis, and appellants are not entitled to additional increases. Second, appellants have not substantiated their claimed home improvement costs. They've been unable to prove both the actual amounts and that they actually paid for these amounts from personal funds rather than from corporate funds or from some other source. This case was deferred several times pending the taxpayers' federal audit and tax court proceedings that related to their involvement in a tax avoidance scheme. Respondent originally intended to take the result of that federal proceeding into account in this case. However, they appear to have settled that matter with the IRS, and so unfortunately, the U.S. tax court proceeding doesn't shed any light on the outcome of this appeal. Appellants purchased the Lafayette residence in 1990 for $1.2 million. They performed improvements to the home in 1991 and 1992, However, they acknowledge they don't know the precise amount of the expenses that they incurred in the remodel. In 1996, appellants sold a 1/2 interest in the residence to Marbell Holdings Incorporated, which is a Nevada corporation. The Nevada corporation was owned by an offshore entity as part of their overall tax planning scheme. The IRS later audited and assessed appellants for their involvement in the entire structure, which involved an income factoring arrangement through the use of offshore entities. Even though appellants sold 1/2 of the property in 1996 for $1,050,000, they recognized no gain at that time because they applied 1/2 of their claimed basis to that sale. They argued that their total basis in the home was approximately $2.8 million. So after applying 1/2 of the basis of $1.4 million, the 1996 sale actually resulted in a loss. I want to note that the total basis claimed by appellants of $2.8 million includes the claimed home improvement expenses that they are claiming today, and it's not in addition to those expenses. Under the terms of the 1996 sales agreement, Marbell paid appellants a down payment of $23,000 and then issued a promissory note for the remaining amount. Marbell began making payments of principal and interest to appellants in 1997. Neither appellants nor Marbell ever recorded any instrument reflecting the sale. However, appellants did receive payments under that note. When appellants sold the property in 2003, they sold the entire interest, 100% of the residence, for $3.6 million. Now, appellants attempt to argue that they actually only sold 1/2 of the residence in 2003, and therefore must only recognize 1/2 of the sales proceeds. However, this argument just defies the facts. First, appellants were the only parties with legal title, and they represented themselves as the sole owners of the Lafayette residence. Second, appellants received all of the sales proceeds. There's no evidence that Marbell received any of the proceeds, and the loans discharged at the time of the sale were appellants' loans. So appellants attempt to argue that actually Marbell was liable for 1/2 of the mortgage indebtedness, but there's simply no evidence that Marbell was ever named as a borrower or otherwise named in the loan instruments. So no documents reflect an agreement by Marbell to take on appellants' personal debts. Appellants received all of the economic benefit from the 2003 sale, and there's no evidence that Marbell or any other party may be treated as the seller of the home. So the overall result of these transactions is as if appellants sold 1/2 of their residence twice. The correct income tax treatment would be to only allow the basis that was not already applied to the 1996 sale in 2003. So their available basis would be approximately $1.4 million if we accepted all of their claimed costs. Respondent has already allowed the entire amount of the original purchase price of $1.2 million, plus additional capital expenses of approximately $60,000, and the entire amount of selling expenses of over $200,000. Appellants cannot treat the sale as if they sold only 1/2 of the home in order to reduce the amount of gain when they actually sold the entire residence in 2003. In addition to the problems with appellants' arguments regarding the sale of the home, appellants may not inflate their 2003 basis in their home using the Cohen rule. They claim to have spent $1.58 million on remodeling their home, and that's based on a project cost estimate provided by appellant's contractor. However, they cannot show with contemporaneous documentation that they actually incurred or paid for those costs from personal funds. They've been able to show that they paid approximately $60,000 in remodeling costs, and so respondent has allowed that entire amount. Although appellants made improvements to their home, this case is not one where a simple estimation may be allowed under the Cohen rule, because appellants have not only failed to prove the amount of the costs, they've failed to show that they actually paid those costs. They mainly rely on a few pieces of evidence to support their claims of having spent over $1.5 million on the remodel, and those are Young & Burton's job cost analysis detailed, showing a projected job cost estimate, a handwritten schedule of payments allegedly made to the contractor, a statement from the contractor attesting that he did perform work on appellant's home, a 1991 permit for improvements to the residence, and a 1995 private appraisal report valuing the residence at $2.8 million. The main problem with all of these documents is that they don't show the actual costs incurred within the remodel, and importantly, they do not show that appellants paid those costs from personal funds. So while the contractor, Mr. Burton, has stated that he performed the work and that he was paid by appellants, he has no record to show the actual amounts that he received, and he even concedes that any statement about the costs or payments would only be a guess, and that's in Exhibit W of Respondent's Exhibits. While the permit shows that appellants did do some remodeling to their home, appellants reported the value of the construction at $266,000 on that permit, and not the $1.5 million that they now claim. That's in Exhibit X4, which is also included in your packet of exhibits. The appraisal report does not reflect the costs that appellant expended on improving the home. The appraisal only shows the value of the home at the time that it was performed in 1996. You can see that in Exhibit L1, page 3. Value is distinct from basis, which is the cost to appellants to acquire and improve their home. It's also interesting to note that the appraisal values the property at $2.8 million, which is exactly the amount of basis that they claim to have had in the home in 1996 at the time of the first sale. So again, they cannot claim that entire amount of basis again in 2003. None of these documents show that appellants paid for the remodel from personal funds. In fact, appellant's handwritten ledger reflects that at least some portion of the payments were paid from appellant's medical corporation. For example, on page 4 of Exhibit Y, you see several handwritten notations next to expenses stating from David's Corp or from corporate. When you consider the fact that appellants have established a practice of setting up offshore entities to pay large portions of their personal expenses, the notations in the handwritten ledgers deserve additional attention. Furthermore, we know that Marvell paid for many of the expenses related to the home beginning in 1996. The company made mortgage payments, but it also paid for homeowners insurance, property tax, and any and all expenses related to the home, as well as appellant's personal expenses. You can see exhibits F3, K3, S3, and Q4, also included in your packet, or some examples of the kinds of expenses that Marvell paid for. Appellants made claims to Marvell for repayment of electrical costs, pool building, concrete, hardwood flooring, carpets, and many more costs. Marvell even made payments for appellants' children's college tuition, which indicates that appellants did not adhere to very strict limits on how and when Marvell could reimburse them. Contrary to appellants' argument that the Marvell transactions occurred long after their construction to the home, we can see from the evidence that in some instances, Marvell did pay for expenses from prior years. Also, appellants maintain that some portions of the loan secured by the home were used to pay for construction. However, after the sale in 1996, Marvell made payments toward those loans. So Marvell paid both directly and indirectly for many of the expenses of the home, including the construction costs that appellants are trying to claim should increase their basis. Of course, if payments from the home remodel actually came from Marvell or from some other company, appellants may not personally increase their basis in the home. As I mentioned, the IRS did audit appellants and concluded that they had engaged in a tax shelter. Appellants appear to have reached a confidential settlement of the matter, and so unfortunately the outcome of that federal proceeding does not have any bearing on the amount of appellants' 2003 gain for California purposes. The evidence here reflects that appellants sold one half of their residence twice, first in the 1996 sale, and again when they sold the entire home in 2003. They applied one half of their basis in the first sale, which reduced their available basis in the second sale. They attempt to argue that the second sale was really only a sale of a one-half interest, but all the documents, including the sale and purchase agreements and deed records, reflect that they sold the home as the legal owners of 100% of the property in 2003. Their debts were discharged in as part of that 2003 sale, and the entire amount realized from the sale is attributable to them rather than to Marvell Holdings. Furthermore, appellants have failed to substantiate their claimed expenses and have failed to show that they personally paid the costs related to their home improvements. Appellants' appeal should be denied. Thank you, and I'm happy to take any questions you may have.
Thank you. do a 10-minute rebuttal for appellants now. You're ready.
Yes. The first thing is the sale to Marvell. That is has been admitted by the Franchise Tax Board, and it's well documented that there was a sale to Marvell in 1996, and that Marvell and the Lindseys became co-tenants. There was an agreement as co-tenants that each would pay half of the expenses, and including payments due on outstanding mortgages. But at the conclusion of that transaction, Marvell owned one half of the residence, with the appellants owning the other half. The next step in that process was that each paid their one-half share of what was owed for repairs, some improvements, and the mortgage liabilities. Then in 2003, when it became time to sell the residence, Lindsey sold their half. And as part of the process, and on behalf of Marvell, the co-owner, sold Marvell's half. They didn't sell, the Lindseys did not sell, their half of their property twice. They sold half their property once to Marvell, and then subsequently sold their remaining half, and on behalf of Marvell, sold Marvell's half in 2003. So that the notion that their basis, which remained after the 1996 sale to Marvell, should be the same basis that applies to the combined sale of both halves is ludicrous. They only owned half the property. They were the only person on the title, but that doesn't mean they were not the owner. They were the owner of half the property, and that's how it was treated. They reduced their basis by half in 1996 when they sold half to Marvell. That dropped their basis in their remaining one half down to roughly 1.4 million. When they subsequently sold both halves, theirs and Marvell's, they utilized that 1.4 million to offset their share of the amount realized. And their share of the amount realized was the one half of the entire amount realized in the 2003 transaction. The discussion of the Internal Revenue Service case, I hope the panel will reject it in its entirety. In that case, the Internal Revenue Service spent ages working on what they viewed as a very sophisticated scheme. Once the audit was completed and the case reached the hands of attorneys that were going to have to try the case for the service, the service conceded the entire case. All the tax, all the penalties. The conclusions of the revenue agent were simply rejected. And it wasn't like a secret settlement. It was a full concession. The Franchise Tax Board requested copies of the settlement agreement. There wasn't any settlement agreement. If you did a full concession, that's the end of it. And the position taken, this lengthy audit, just disappeared. As rejected by their own legal scheme. So there isn't any question that after the 1/2 interest was sold to Marvell, that Marvell did contribute to improvements after they became half owned. They were required to. However, we're not asking for the basis to be increased by any of those payments. All we're asking for is that the base be increased by the improvements made in 1991 and 92. And there is no question, for example, respondent's counsel suggests that there isn't any, we don't have any evidence of how much was paid to this giant improvement work done by Young and Burton. Well, that's not the case. Exhibit number 8 that we have submitted, and has also, oddly enough, I think, been submitted by the respondent, has Mr. Burton's notation that this is what the job cost, and this is what we were paid by Mr. and Mrs. Lindsey. He also has sent a letter to a franchise tax board counsel, that's exhibit number 10, that the payment was made by the Lindsey. So the fact that there's some guesswork involved in how much was paid and by whom is not correct. There isn't anything untoward about the sale to Marvell, which has been admitted by the respondent. And the way it had to be handled was the way it wasn't. The Lindseys, they sold half, they could only retain 1/2 of their original business. And when they sold their half and Marvell's half in 2003, they had to split the amount realized. They allocated themselves half the amount realized, and Marvell the other half. Now, Marvell was under a set requirement to pay some of its abilities to the Lindseys. So when it came, it had to give up some of the amount it realized in order to satisfy that obligation. But that doesn't change the amount Marvell realized, and it certainly doesn't change the amount that the Lindseys realized. Amount realized is a legal term, and that is exactly what they received, and that's how they handled this transaction. And it's in a supplemental brief makes the calculation of how the gain should be reached. There needs to be some tinkering with it because the respondent has graciously given appellates a few additional improvements and that sort of thing. And I think the closing costs are a little bit different, but the treatment is described in that supplemental. We commend it to him. Thank you.
We turn now to see if my panelists have any questions. Judge Tate? Judge Gast? Okay. I may have a few questions just for clarification. I'll start on that last part that you were talking about, appellants. Sort of the question of did the sale proceeds go to Marvell? And FTB has said that 100% of the proceeds went to appellants or paid off, satisfied their liabilities and debts. At the end, you mentioned that there might be a separate requirement of Marvell to satisfy obligations to the Lindseys. Can you explain that further and point to any exhibits that kind of justify that statement?
Let's see. There is an exhibit not we haven't submitted. I think it might be among the exhibits responded to that. I'm not sure. But there is, in the record, there is a provision of how the sales receipts will be distributed. A certain amount goes back, I think it's 23,000, goes back to Marvell. Then a certain number goes there. Slightly over $1 million, as I recall, goes to the Lindseys. My recollection is the rest is, the excess is divided equally between the companies. I believe that's it.
Franchise tax board, is it not familiar with those numbers? Sound familiar?
I believe that may have been in the promissory note or the deed trust promissory note. But I think
I'm not sure it's in the
what's important to note from that is, so if the documents required that Marvell received $23,000 from the sale, I don't believe that Marvell did receive $23,000, or there hasn't been any evidence that shows that Marvell received anything from the sale.
Are there any documents that show that Marvell did receive its 50% portion, or with some adjustments perhaps, and that maybe that was allocated to outstanding debts it owed to the Lindseys? Any post-sale documents or concurrent with the sale?
I'm not sure there are such items. I don't think it makes any difference. The amount realized is the amount realized. And a separate agreement to on the distribution of the profit from the sale had nothing to do with amount realized. Amount realized is defined by the record. And if you have an obligation to pay part of that profit after you receive it, then that doesn't change the amount realized. The amount realized stays the same. Just the difference between the adjusted basis and the sales price. What happens then to those proceeds is, of course, of interest to the co-owners. Doesn't change. Doesn't have any effect on that.
Let me stay on that topic. We've got a franchise tax board. Looking back at the 1996 year with the sale to Marvell, 50% ownership, and then coming to the 2003 sale, and maybe the difficulty might be because 1996 tax year it was audited, or maybe it was outside statute of limitations by the time this issue came up and this audit began. But I guess walking through, how is it possible for the Lindseys to have sold 50% interest and then later to have sold 100% interest?
Right. So I think that if this were an ordinary sale or an ordinary series of transactions, it wouldn't be possible, because you would sell one half of your home and you would only retain one half to sell later. But this wasn't ordinary. They didn't actually transfer anything in the first sale other than, they signed the promissory notes. So there's no legal title that ever transfers. When they actually went to sell the home in 2003, they still had the legal right to sell the home, and in fact they received the economic benefit of both sales. So they received, the down payment in 1996 and then payments on the promissory note. And then in 2003 they received the benefit of, the $3.6 million. And I think all of those sales proceeds went to them or to pay off their debts.
Can you just clarify, you're saying that the Lindseys received $5 million from 1996 to 2006?
Well, not in entirely sure of how many payments on the promissory note that they ultimately received, because I don't think we have documentation to show how much they received in the end. But yes, I mean, they essentially received the economic benefit of, I guess, 1 million plus the 3.6 million, so 4.6 over the course of both sales.
They were able to show that they only received the
I don't think so, because there was a promissory note that in theory they could have enforced. So even if they didn't receive all of it, they still received benefit, the economic benefit of $1,050,000 in the first sale.
Like taxpayers are stating that the proceeds for the sale of 2003 were satisfactory.
Right, and we don't have, again, there's no evidence of that, so we really have no way to know how much debt was outstanding or if there was any.
I think the promissory note was 30 years with 7% interest. Does that sound correct for promissory note terms? Do appellants know how much was paid on the promissory note? Was it at the standard rate, so it was about 1/3 paid off?
There is a list. One of the exhibits we came across that was actually filed by respondent was some sort of scheduling of monthly payments. I don't know whether it was a schedule or whether it was something that listed what had actually taken place. I don't recall. But there is a document also previously filed by respondent that sets forth what is to happen, how the co-tenants handle any of the proceeds from the sale. There's a separate document that sets up forth that I believe it's been filed. It may even be among the exhibits that have been provided to this panel. If not, appellants can locate it and provide it to the panel and to respondent if it's of interest to the panel. From our perspective, it doesn't make any difference what that arrangement is. The arrangement set forth, and there was a deed and promissory note, all that, was that half the property, Marvell became the owner of half the property. The Lindseys were the owners of retained 1/2 of their property, and of course they reduced their basis in their 1/2 by half. And in 2003, both halves were sold. Of course, the Lindseys, since they were the only name on title, recorded title, had to conduct the sale on behalf of, for their half and on behalf of the co-tenant. That's how that took place.
And appellants, just to clarify, maybe one of my final questions here. When you're looking at the sale proceeds and you're looking at the adjusted basis, you're taking half of both of those to apply to appellants, is that correct? Half the sales price and also half of the adjusted basis?
Yes, except for a few selling expenses, that sort of thing. Yes.
And franchise tax board, you're looking at the full sales price applies to appellants. And you're giving them the full basis, but you're only giving about $61,000 in improvements on top of the 1.2 purchase price.
Right, and the entire amount of the selling expenses.
I think that's my last question. Any questions, Judge Bass?
Yeah, actually, one question. If it's relevant or not, you can tell me. But just so I'm clear, who owned Marvell? I feel it was an offshore entity.
I believe it was, or it was linked to an offshore entity.
Was it a third party entirely, or?
I don't know. But it was there was a linkage. Marbell wasn't just standalone. It was connected to, maybe not directly, indirectly to some entity offshore. According to the IRS agent, there were just a whole network of offshore entities that were doing these, what the agent regarded as shenanigans, that we haven't pursued in this case. What the linkage was not. The revenue agent's belief was that every dime that Marbell contributed was actually Dr. Lindsey's factored receivables. And that was their position until it became clear to them that it was something that could never be shown.
All questions, Judge Taylor?
Can I point out just something?
Yes, please.
I want to point out something in the record in Exhibit U to show that there was nothing untoward about Marbell from the standpoint of the taxpayer or his representatives. It wasn't, all of the planning that was done was legal, and at that time, offshore planning was legal and proper until a certain point after all of this happened. And I point to Exhibit U, where I'm providing everything the agent wanted, and I provided on October 19, 2007, as set forth in Exhibit U, a copy of the agreement of purchase and sale between the Lindsey sellers and Marbell Holdings Inc. purchaser. So I'm pointing that out to the record that there's nothing untoward from the standpoint of the clients and even of the law, because at that point there was a lot of offshore permissible legal until a certain point, but that came afterwards.
Thank you. Unless there are any further questions, I believe we've come to the end. We have the evidence that's been submitted and admitted to the record. We have the arguments and briefs as well as oral arguments and testimony today. We have a complete record from which to base our decision. Are there any final questions from either party before we close the record? Hearing none. I want to thank both parties for the efforts on appeal. This oral hearing has been very helpful to us. The record is now closed. This concludes the hearing on this appeal. The parties should expect our written decision no later than 100 days from today, October 28, 2019. With that, we are now off the record. We will take a break for lunch. We'll come back here in 1 hour at 12:45, and the next hearing is scheduled to start at 1 p.m. Thank you.
Thank you.
Thank you. Thank you very much.
Thank you very much.
Even though she just said it, I have to say it to get it on the record. We're now on the record in the Office of Tax Appeals oral hearing for the appeal of Design Home Center, case ID 1807-3484. We are in Van Nuys, California, and the time is approximately 1 o'clock, Monday, October 28th, 2019. My name is Jeff Angija. I'm the lead administrative law judge for this hearing. My fellow co-panelists today are Andrew Hui and Richard Tay. And appellants, could you please identify yourself for the record?
Victor Smiles, owner.
Carlos Che, CPA, BOA.
And for CBTFA?
My name is Scott Lambert. To my left is Lisa Renati, and to her left is Chris Brooks, representing the California Department of Tax and Fee Administration.
Thank you. And as we discussed in our pre-hearing conference, this appeal involves two issues, which are whether reductions are warranted to the audited amount of underreported tax on sales, and whether the understatement was the result of negligence. Prior to our pre-hearing conference, CBTFA had identified and provided exhibits A through D for admission into evidence. And appellant had no objection. Is that still the case? No objection? All right. I hereby admit exhibits A through D into evidence. And then at the pre-hearing conference, appellant indicated that it had no exhibits. We allowed some additional time till October 14th to submit any additional evidence if you wish to. We still haven't received anything, so.
It was sent by certified mail and October 15th.
Okay, we don't have that. Is that the email?
No, it's certified mail.
No, I know. What's the content of the?
The content is 1 through 6 exhibits.
Okay.
6 additional.
Can we get copies of that? So, okay. Well, while that's being done, we'll go ahead with the rest of the housekeeping matters that I've got. Based on our pre-hearing conference, it was my understanding that Mr. Ceballos will testify today. That's still correct?
Yes.
Okay. I'll swear you in shortly. We had also agreed that we would begin with the appellant's testimony and argument, which would not exceed 15 minutes. And CDTFA would then be allowed to ask questions if they wish, as would the panel of judges. CDTFA would then make its presentation, not to exceed 15 minutes. Co-panelists can ask questions if they wish, and then we will allow a 5-minute rebuttal for appellant. Do you need those documents to give your presentation? Should we take a quick time out?
Yes.
Okay. Let's go off the record for 2 to 3 minutes till she gets back. While we're still on the record, can I ask, did CDTFA receive the exhibits that I'm talking about?
No.
Mr. Chait, did you just send a copy to Office of Tax Appeals and not to the opposing side?
Only to tax appeal. That's why my understanding is over before. So now here and do this one.
So
6150.
you were supposed to receive it by the 14th.
Yes, and I said like,
Receive it by the 14th because we're supposed to have it 14 days in advance of the conference, in advance of the hearing.
I remember there was a holiday.
What?
There was a holiday one of these days in Mali was for the October 12th. I said the following day.
Columbus Day.
that's not a lot of time to review it, but can we go back on the record? So for the record, sure was an oversight that was mailed to this building, and Office of Tax Appeals doesn't have an office here, we just have the hearings here, so that's part of why we don't have it in our system. So they've not received it, we've not received it. The CBTFA going to object.
Yes, Your Honor, we're going to object. They, obviously, it's not some time, or even on the date that it was mailed, was some time. The order then that the records be sent by email, so electronic, to both OCA and the CBTFA by the 14th of October. Nothing was sent to us at all, and the certified record shows that we sent it after the 14th. And we run that.
And I know that that's correct, but given the likelihood of confusion and at least the attempt to try to comply, given that it was the holiday, I'll let it in. The rules of evidence don't necessarily apply to the admission of evidence, but it does apply to the weight that we give it. Wait, I hate to say it this way because I've been told this in law school, we'll let this in for what it's worth. Let me swear you in. Please stand and raise your right hand. Do you solemnly swear or affirm to tell the truth, the whole truth, and nothing but the truth?
Yes, sir.
All right. When you're ready, you may begin. And you are under oath.
I'm going to start.
Sure. Please speak into the microphone so the...
All right. Can you hear me well? Maybe this is not organized the way that I want. It's my first time in the Office of Tax Appeal. I have a lot of experience with U.S. Tax Corp and with the administrative and the EDD. But it's my first time in the Office of Tax Appeal. Please allow me to make some mistakes. Sure. I'm not a lawyer, I'm just a civil. Okay, the situation with this audit is the company, were not well prepared for the audit. A big part of the assessment was, unfortunately, our mistake, to not give the right record, to not present the case in the way it is. I take over the accounting of the business only in 2018. I get familiar with all the procedures and everything, and I try to get back to the record to see what happened. According with the page, Schedule 12, page 15, say taxpayer did not maintain a formal accounting system. We do have. That's the reason we entered this one. The company has you can say, sophisticated POS system made for them, for a company called Garicor, no? Garicor. I've been using for a while. Thus, we have a report of the sale for the second part of 2010, the whole year 2011, the whole year 2012, and the first 6 months of 2013. We don't have this already. That is almost that is right. Okay. I don't know if I can, but we are affronting the second audit. And the second audit, there is a representative over there to our office, to our office, and we meet with them, we explain, and he find the almost was very good. And as a matter of fact, the second audit by Mr. Henry Chen, he ordered to be redo. Okay, but let's back to the first audit. We never had really the way to present the information correct to the audit person. That's our first mistake. The second mistake, that's the reason I put this letter, this page called ACC receivable total, because when the company was passed to Mr. Victor Ceballos, who is the owner or the former owner of the company, He received the company in very bad shape. Remember 2008, all the problem with the home, reputation, blah, blah, blah. He has a very big count in furniture. As a matter of fact, many of the clients he has don't even pay or disappear. Okay, so he get the business in very bad shape. So one way to try to recover the business was try to collect the account receivable. That was incredible, $300,000. He started pushing that one. What happened in this case, unfortunately, there is a form called 1099-K. You may be aware of that. It's a form issued by the company who processed credit card. Because it was very big for him this 2 years. And everybody assumed that was sales. It wasn't sales. It was a collection of previous account receivable already reported to the Board of Organization. And the time in 2008, 2007, when the sale was very high. Because that affected the evaluation of the audit. And was probably also became my mistake to not be aware about that until later on. I became aware when I started taking the accounting. I see the difference between the bank, between the real sale and all this, because we are affected by the collection of previous year. That was one of the big problems, that we were like in the shoebox, because we cannot negate, it cannot be the account, the amount that the 1099-K at fault, no, are correct. But the things include something that is not for the year. Because it does create a big difference. And finally, your guy audit, make something called markup. Do a markup over there with doing two things. Number one, taking all the furniture on the floor, write down the price, and ask my client for the purchase invoice. In some way that's good, but in this business is not so clear, because the price on the sticker is never the same the price sold. There is discount, the guy buy one furniture, two furniture, a complete set, etc. Because he never asked for the sales invoice. He only take the price on the sticker. And the invoice also, he never, the invoice are there. I mean, there is nothing to hide. Also, some of the stuff was purchased 1 or 2 years ago. Other problem he has is the inventory. He has a big inventory. They start getting real inventory, little by little. They have 2 or 3 stores sometimes. And suddenly everything went down in 2008. You know what happened those years. Entonces, they started picking up inventory, studying at whatever price they can get from that. So the markup analysis shown on page 16 may be close to the reality, but we don't accept it. At least we can do something more scientific. Thank you.
If I'm understanding the argument correctly,
yeah,
the amount of the 1099-K payments, the credit card receipts, you're saying that those represent collections on accounts receivables from sales made in prior years?
Yes, they were inflated by that.
How does that work? I mean, you've got the account receivable already, so they come in and they pay a past due balance with the credit card?
So when I took over that part of 2009, my dad had receivables before that. So when I took over, when he went under, he passed everything on to me. So I said, I'm going to collect all the receivables that didn't pay. I mean, customers for months, years, which we still had a right to get. He lost a lot of money, so I didn't want to let that go. So what I was doing is I was learning how to collect, legally, and as you know, as I can do. So we were receiving payments, credit card. We're coming to the store, pay with the card. We're collecting, sending letters, calls, whatever we can do to collect. I just didn't think about the issues that would happen. I guess it was new to me as far as all this tax stuff, but I guess that's what they didn't match with what I was doing.
I have additional questions, but I'll hold off to the meeting.
I did have one quick question. I just wanted to know on the federal income tax returns, were those reported on a cash or on an accrual basis?
They're cash basis. I prepared all the taxes.
CDTFA, would you like to commence your presentation?
Sure. In this particular case, we audited the taxpayer for a 3-year period. They are a retail furniture store. The appellant provided income tax returns for initially 2010, 2011, 2012, and after the initial audit, they provided the 2013 income tax return. They provided some purchase invoices, the 2010 profit and loss, and then we had the 1099-K information that they provided for 2011 and 2012, or I'm sorry, we obtained from our headquarters operations information that we had obtained. The records that weren't provided were the source documents. They didn't provide sales journals, and they did not provide the sales invoices themselves, and a large percentage of the purchase invoices weren't provided. We did try to contact the suppliers, and we were somewhat unsuccessful in our attempts to verify the purchase invoices. So essentially, we accepted the figures that had been reported on their income tax returns because that was all we had. There was large differences noted between each one of the years. So, and between what was on the federal income tax returns and what was reported on the sales and use tax returns in terms of gross receipts and total sales. So in 2011, the difference was $266,000. In 2012, it was $382,000, and in 2013, it was $241,000. Since it was only half of 2013 that we audited, we essentially took half of that figure, which was $120,000. The amount on the 2010 income tax return matched what was on the sales and use tax returns, with the profit and loss that they had provided us was substantially higher. So we did use the figures from the 2010 profit and loss statement. So essentially, that's how we audited their taxable sales, because that was the only evidence that we had in order to conduct this audit. Now, there was, we did attempt to verify this, or we did verify it through alternative methods. One was the credit card method, and what that showed is that their credit card sales were about 87% of the reported, or the sales on the income tax returns, and that was a figure that we considered to be reasonable for this type of business. And then we also did a markup test, and we came up a little under 40%. It was 39 point something percent. And if we had used the markup method, the liability would be higher than the figures that we obtained from their income tax returns. So because there was not that much of a difference, we went ahead and accepted the figures on the income tax returns as their sales. The taxpayer has indicated that there were some non-taxable receipts included in gross receipts, but there hasn't been any evidence that's been provided to show that that those figures were in fact included in the gross receipts on the income tax returns. So essentially, we have no method of determining what's included in the income tax, the gross receipts on the income tax returns, because we don't have the detailed information. And so what we're relying upon is that, or essentially that those sales are subject to tax until the taxpayer proves that they're not, and that hasn't happened yet. In regards to the negligence penalty, we did put a 10% negligence penalty, and it was imposed for two separate reasons. One, because there was a substantial underreporting of taxable sales, over $900,000 in taxable sales, and also because they failed to provide a complete books and records for audit. Negligence penalties should be upheld in a first audit if the understatement cannot be contributed to a bona fide and reasonable belief that the bookkeeping and reporting practices were sufficiently compliant with the requirements of the sales and use tax law. So in this case, you have an underreporting of $917,000, which is an error rate of 175%, and essentially they reported less than half of their taxable sales. They were also able to report the sales on their income tax returns, but unable to report them on their sales and use tax returns. And there's a difference between the 1099 for 2011 and 2012 compared to what was reported of $600,000. As their testimony is that it was because of collecting back payments. That seems like a substantial difference of accounts receivable that were collected during that time period. I note the information that was provided here. I just recently provided today. I've only been able to glance at it and look at it briefly. So at this point, because we have received it recently, it would be the same thing as taking a look at the income tax return. We do not have the backup for this to show that it is correct. There's nothing to show how these figures were arrived at other than what's on this piece of paper. I would point out that we did have a profit and loss for 2010 that we used to establish the liability. I don't know what the difference is between the 6 months that they've provided here and what we have been provided earlier. So unfortunately, I'm unable to discuss it more than that at this time anyway. So with that, I would conclude my presentation.
Thank you. Judges, do you have questions for the board? So this is where we allow you a 5-minute rebuttal if you want to wrap up the argument and or respond to what the department is saying.
I don't know if inside the California Department of Tax and Fee Administration respond between each other. I have a letter from Mr. Henry Chen, who is your tax counsel specialist, who reviewed the record and find out that the record has to be reviewed again. Because he agreed, he went to our office, checked the system, the post point of sale system, and find out everything is okay. There was no, because he was thinking that maybe we do some changes for that. But we ask the audit will be redone. And regarding the tax 11, 12, and 13, I was prepared for them. Okay, based on the information provided by the company, I can say the profit and loss, the gentleman mentioned, was designed by the system, was very poor and incomplete. Unfortunately, they have some person has taken the record that do a very good job. That's the reason I take over last year. But this record, for me, as a CPA, are not reliable. For example, in 2011, the profit and loss mentioned the state tax as a deduction. I don't know how they consider the state tax, the sales tax. It's supposed to be reduced from the sales, reporting just the net sales. There is a lot of mistake, and not the tax is an information provided by the tax, by them for tax preparation. And the other thing was the 1099K. And it's $2, there is amount already out. Now, I find out later on the explanation what happened. Okay? But basically, we request if it can be redone.
So
we have the report of settlement.
I had a quick question. You're referring to a letter from Henry Chen.
Yes.
I can't pull it up fast enough. Are you referring to a subsequent audit period with
Yes.
Henry Chen?
Yes.
Okay.
That letter was supposed to be included in the package I sent.
Yeah, although if it's not for this audit period.
Yeah, we didn't make a photocopy about this letter, but that letter was included in the package.
But if it's not part of this audit
No,
period.
it's not the audit period.
It's not relevant to this audit period, so.
It's relevant in the sense that the guy decide that there has to be a new audit because the information, they have information to do a correct report.
Right, but it's not for the audit period in
No,
question.
no,
So.
for the subsequent period.
Okay, and does that conclude your presentation?
Yes.
Judges, do you have any questions? Okay, so then, at this point, I will close the record. We will conclude this hearing. I'd like to thank each party for coming in today. Following this hearing, my co-panelists and I will discuss the evidence, the arguments, and we will issue a written opinion within 100 days of today's date. So with that, the record's closed, and thank everybody for attending.
Thank you.
Ladies and gentlemen, my name is Michael Jewerly. I am the Administrative Law Judge with the Office of Tax Appeals. And I'm joined today on the dais by my colleagues, Kenny Gass and Daniel Cho. While I'm the lead judge for the purposes of this hearing, we are equal participants, or will be equal participants in the deliberations that will take place in this matter. We have a court stenographer or a stenographer who's taking down everything that is being said, and to help her do a good job and to help all of us have a clear and easily read and understood record, I'm going to ask you to speak slowly, speak clearly. Do not speak when someone else is speaking. You might feel the urge to interrupt, but don't do that because then you'll have confused record. And it would be best not to assume that if you engage in a conversation, perhaps with your representative at the table, don't assume that it won't be heard, picked up by the court reporter. It's best to go off the record if you wish to have a discussion like that, or to go outside during such a discussion. Who is here to represent the appellant?
Patrick McGinnis.
Mr. McGinnis, and who's with you today?
Mr. Jack Yermogin, who was the operator of a company that comes up with Ibrahim and Jewerly, and the client, Ramco.
Good afternoon, gentlemen. And who's here to represent the market?
My name is Scott Lambert, and to my right, left is Lisa Renati, and to her left is Amber, and representing the California Department of Tax and Fee Administration.
Good afternoon.
should have been using this mic from the beginning, and assuming the court reporter heard what I've said. Usually I project okay, but I've been cautioned to make sure that the people at the tables who are speaking and my co-panelists who don't have the benefit of microphones in front of them, that they speak up loud enough for the court reporter to hear, the stenographer to hear, and take down accurately what is said. I prepared a package of evidence and asked my staff to provide copies to the parties. It is a digital folder that contains all of the evidence and indexes, and there should be functioning bookmarks on that too, so that you can jump right to the evidence if somebody's making reference to the evidence, and I hope that you all have that. We've got the appellant has offered 9 exhibits so far. They're marked 1 through 9, 54 pages total. I have not received any objections from the department. I'm assuming the department has no objections to those 9 exhibits.
No objection.
I'm going to admit those exhibits. I understand that Mr. McGinnis came today with some additional documents that have been copied and provided to the department and to my co-panelists. I've marked that document Exhibit 10 for identification only. And Mr. McGinnis, do you want to briefly tell me what this is and why we are just hearing about it today?
I visited and interviewed the principal witness, Chapter Mogin, who I asked him to search his records, even though the records of Jewerly were disposed of by the account. He found those, I think, in his house. There were some other documents that didn't relate to this. There are receipts for checks, and they were for the year, I think, the year 05, and they totaled $230,000. The reason I brought them is they lend credibility to this testimony which is here, which is Jewerly was a major manufacturer in this Los Angeles area. We have a lot of employees, and Acapulco was a supplier of raw materials to them. This lends credibility to the testimony to that effect.
When you use the term Acapulco, who are you referring to?
It's Ramco, it's about.
And Mr. Is it Yamajian?
Yes, sir.
Mr. Yamajian is going to be testifying?
Yes.
And you will be able to lay a foundation for
Yes.
these documents?
Yes.
Department, any objection to the admission of the evidence?
Yes, Judge, we certainly do object. The deadline to submit evidence is long past, so we certainly object to appellant walking in at the last minute of hearing with never before seen records. Further, these records are dated outside of the test period that was used for this case, so they are irrelevant. So we object based on untimely, the fact that they're untimely, and also they're not relevant to this appeal.
Mr. Aganis, a quick response, if any?
These records can be received as evidence, as corroborative evidence supporting the testimony of the witness, Mr. Yamaki, that Jewerly purchased large amounts of raw materials from the appellant. The appellant was in the business of supplying gold, silver, diamonds, precious stones, and other items to Mr. Yamaki's company, Jewerly. This shows that this is not a figment of their imagination. And I mean, I did not know about them. I can assure the court I did not know about these. I met Mr. Yamaki this weekend, and he produced it.
All right. I'm going to defer a ruling on the admission of the exhibit marked 10 until after Mr. Yamagi's testimony. The department submitted 9 exhibits. They have been marked A through I for identification, 3,074 pages. I received no written objections from the appellant to the admission of the department's evidence.
We have no objection.
No objection. Then those exhibits A through I are admitted. Does the department have any additional documentary evidence that wish to be considered?
No.
distinction that OTA is an independent agency completely separate and apart from the tax agencies that appear before it, including the California Department of Tax and Income Administration. Arguments made to the department and evidence filed with the department are not necessarily before us. I think Mr. McGinnis understands the evidence that is the part of the record of this hearing is the evidence that I had digitally produced and that you have a copy. Do you understand that, Mr. McGinnis? Mr. Lambert, do you understand that? This is an appeal from an August 30th, 2011 notice of determination issued to Ramco Jewelry Corporation doing business as Abdelkerim Jewelry Plaza for $1,235,321.68 in tax, plus interest, and then a negligence penalty of $123,532.17. The California Department of Tax and Income Administration, which I will frequently refer to as the department, determined the liability by audit. It initially disallowed appellant's claimed non-taxable sales measure of $14,973,595, and later reduced that measure to $14,275,351, which is the current measure of issue. The appellant contends that all sales for resale were accurately reported, that no tax was due, and that it was not negligent. Is that right, Mr. McGinnis?
That's the position I'm asserting.
Okay. The parties agreed at a prior pre-hearing conference that the issues to be addressed today and by the judges in the future as we consider the issues are: one, whether appellant is entitled to a reduction of the measure of disallowed claim non-taxable sales for resale, and two, whether the negligence penalty should be deleted or whether the appellant was negligent. You are going to, Mr. McGinnis, you are going to call both your client and Mr. Yamani, correct?
Yes, sir.
And in what order?
I was going to call Mr. Yermagin first.
Okay. Mr. Lambert, do you have any live witnesses today?
We do not.
Frequently, when a party is calling a live witness, I will allow an opportunity for the parties to give opening statements, but those opening statements are generally limited to a summary of what the evidence is going to, what the testimony is going to be. And given our time constraints today, I'm going to dispense with that. I'm trying to assure you that the three of us on the dais do not need those opening statements. We're going to go directly to the testimony. Following the testimony, we will have arguments. When a witness testifies, of course, the department has an opportunity to ask questions. My co-panelists and I have an opportunity to ask questions. We'll go through both your witnesses that way. Mr. McGinnis, you'll have 15 minutes for your argument at the conclusion of the testimony. The department will have 15 minutes for its argument. If you need more time, tell me before we begin so that I can keep track of the time.
That will be enough.
And then you'll have a 5-minute rebuttal if you choose it. After the department gives its arguments, I'll come back to you and give you 5 minutes for rebuttal, and that'll conclude the hearing. I'll close the record, explain to you what's going to happen next, and we'll be done with the hearing. Understood?
Yes.
All right. If it's all right, I'll administer the oath or affirmation to both of your witnesses at the same time. Just to save time, would you both stand and raise your right hands, please? Do you solemnly swear or affirm that the testimony you are going to give in this matter will be the whole truth?
I do.
Thank you. You may sit. And you said you wanted to examine Mr. Is it Yermagin or Yermagin?
Yermagin.
Yermagin. Okay. You now have the microphone in front of you. However, Mr. McGinnis doesn't have a microphone. I wonder if you two would sit next to each other just to put the microphone sort of in between you. And then try to lean forward and speak into it when you speak. You can proceed when you're ready, Mr. McGinnis.
Okay. Could you identify your name and address?
Abdelkerim, 1048 Trafalgar Drive, Glendale, California, 91207.
Spell your first and last names, please.
Hakop, last name is Yeramagya.
During the years 2005 to 2010, where were you employed? Where did you work?
In Glendale, 671 West Broadway, German jewelry manufacturing premises.
What did German Jewelry do? What was it?
Manufacture jewelry.
How many people worked for you during the 05, 08?
I cannot recall, mostly because after 2000 we had to move production overseas because of the reasons given to us, the pricing, all other stuff. So we had a facility in Armenia, which I had to go to be able to compete with China, India. So basically, a lot less than we usually had, like, a lot less than we usually had before, but probably like maybe 10, 6. I'm not really sure. I don't want to give a number because I feel obligated. I don't lie ever in my life, so I don't want to be liable. If you want to guess, I can guess.
What type of jewelry did you make?
All types which I could sell. Tennis bracelets, ring, earring, pendants, chains, link chains, finished jewelry, mountings. Mountings are jewelry which is not 100% finished. You sell it to other wholesalers who then reproduce it or finish it up, basically putting some stones, on the mountings and make it finished jewelry. Give to retail stores to sell or sell it themselves.
What did you buy? What did German Jewelry buy from the appellant, Mr.?
Not only him, we used to buy from a lot of other suppliers, gold, diamonds, power stones, scissor stones for our production. And after using them in production period, we try to sell it to big wholesale companies and if there are other retail companies who wouldn't buy from us or we could sell them, we try to sell to them.
Was this wholesale or was this retail?
Which one?
Your
I
business?
never done retail business. My business only was wholesale ever. It will, I mean, if you take my license, it's not here, I have the page, it's a wholesale jewelry manufacturer. We couldn't deal with people. We had like, we produced, let's say, thousands of rings in a week or bracelets, and then I couldn't sell to the people. They couldn't come. It's like close place. We had to secure the place in order we don't have robberies. You have a lot of security issues. There is a lot of people send you gold or diamond to finish up for them, and you send them back. And what happens? You are responsible for that thing when the company trusts you, co-sign that, let's say. We didn't want to deal with anybody except doing what we did the best, produce jewelry, that's it.
Did you make a search of your home and other premises for any records that you might have still have regarding your jewelry?
What can I say? I mean, I did my best, but I just got this stubs or whatever you call it on the checks, which basically my company wrote and I signed, which you don't see there. I'm sure there's only the portion of the check, which is the stop. That's what you call it. I don't know what you call it. So it shows that I wrote the check. Actually, German Jewelry Manufacturing wrote the check to our company for certain amounts, whatever is there. I cannot guarantee it was cashed, deposited, whatever happened. And I'm sure if I wrote it, it went through the bank, and you should see on the reflection is on the what it is, the bank statements for that month particularly.
What was the typical transaction in 05, 06, or 07? What was your typical transaction with your
it was too small to even remember. Yeah. For me, for my size of the business that we used to, it was too small because we used to buy like 3, 5, 10 kilo gold a day in order to produce merchandise.
How much is 10 kilos of gold?
Its daily price today is like 10 kilo gold is like 480,000. Yeah, more than 480,000 today.
When did you first meet Ramco?
1980, I would say after 87, 88, somewhere there. We used to sell them jewelry. They was in New York. There was different name, and there was a partner, Mike, I believe the name was. Then we moved to California, and the relationship continued giving whatever we could do for each other as a business wise, make money, help each other, make money with it.
So where does trust work into the equation of how you do business?
It's very difficult. It's not a grocery sale. You don't sell $5. It's not a grocery sale store. You sell $5 in a bottle for $2. And whatever you sell is large amount, and profit is margin is very small. I feel in my whole business time was not even 2.5% gross whatever we did, which was the gross profit out of the gross sales. So it's very, very intense, and it has to be guaranteed. We have to know these people upside down. Somebody has to recommend. When basically you recommend, in my practice, that's how I work, the guy becomes responsible for the guy he recommended. So basically, when somebody came to me and says, it's okay for him to get some kind of credit from you or time to pay you. If the guy somehow couldn't pay, in our business, board is the most important thing. You're finished in my business if you lie or cheat or anything. So the guy had to come up with either help me to collect or pay me. So basically it was board, and then any other tools we can get, credit agencies, the size of business, where he was doing, did he have simple things which people do on the gut sense. You have a gut feeling when you shake hands, Sometimes the guy is good. It happens. Test. It doesn't mean we didn't lose money but that's how you do it.
So you want to be able to put you on the line. Are you getting this okay?
Yes.
Would it be louder?
I need him to be a little louder.
Louder is
Yes,
better.
please.
I'm very sorry.
And
I'm
slower.
not used to this.
Speak more slowly. I might suggest you also listen carefully to the question and just answer the question so that we can move along.
Sorry.
Okay.
Who was the boss of Yearman Jewelry?
Me and my brother, unfortunately, he died. At the time my brother was.
What role did you perform in the preparation of state sales tax returns?
I had a CPA, and he did all the paperwork for me. We had an in-house accounting system, computerized. All the invoices, checks, was the kind of memos, assignment papers, all that stuff was brought together, reports were printed, give it to CPA, and CPA conduct his part of the business. Taxes, all the federal payments for employees, all that stuff, they calculated to give it to us. We had separate account for the payroll, we say the separate accounts for the business thing, so we try to separate everything so we have kind of clear idea, clear way to answering all the questions that could come to us from anywhere.
Is your description of how you operate the jewelry business characteristic of other vendors in the jewelry district of LA?
When I was doing after 95, a lot of people don't, because I was power enough to employ right people, hire right people, make enough profit to pay all the other stuff I do. But before, when you start, it's very difficult, and most of people try to do themselves, everything what you can, save money, make the business work, start, try to bring everything, borrow money sometimes, to do this, you do that, in order to kind of grow. I think that at the time when we were talking about it was actually the part when we were going out of business because of overseas business. forcing us to compete. Whatever we need to do.
How much it was trail off?
We couldn't compete with overseas.
Yes,
Yeah.
Can you estimate the amount of annual business between Yerma and the appellant?
I hate to give any numbers because I'll be lying, because I don't know. Estimate, what is the estimate? I don't know. But judging that paper of what I found, I mean, it shows like what it is, like 2-3 months of transaction, and so it's less than $230,000. You know, it could be double of that, or it could be, you know, next year could be triple. I can't say. I have to have a hard proof to tell you this is what I did, which unfortunately I don't have. But in our business, because of the value of the diamond and gold what you purchase, some people think it's a lot of money. It's not our money, it's material. Somebody buys the flour for $5 a pound and sells bread for, let's say, 10. But this is, you buy gold for, let's say, 12,000 a kilo, right? Then you make, let's say, $3,000 on it. And it's the cost. Then you have to pay all the expenses on whatever is left to you, especially because in manufacturing business, my business, people lose gold. You know, they touch, they wash, they steal, whatever they do. There are 20 people, everybody loses 1 gram. It's like 20 grams gold today is ounces of $1,500. It's $1,000. It's difficult, very hard business. It's not normal business like people do. It's not transaction like, you know, you have items, you itemize and you put it. You try to do all that stuff to be able to control the loss, manufacturing loss, the normal loss what you which have. Then stealing, then items. It changes very rapidly because it's a fashion. You produce something today and then, you know, after a month it sits in your, or a year sits in your safe. Nobody wants to buy it. You gotta scrap it out, take the money out. The money always scares. I mean, you spend $100,000 a day, but in the end, you don't have money to pay the bills because the material sits there. You couldn't make enough sale, or you didn't make profit. It's difficult business. That's all I can say.
Describe a typical transaction when you needed gold or whatever. How did you arrange a sale, and what happened from beginning to end?
We had a lot of different gold dealers who supply us with gold for different prices, premiums. Premium ranges from like 75 cents an ounce to $5, $6, $8 an ounce. Depends who's buying, how much buying, what is type of business, how powerful the guy is in the business, how much business you give to that particular supplier. So there was time, for instance, I bought from different places because I didn't have money. Let's say I could call somebody, P&K Gold, which is in downtown, and I said, you know, Mr. Gary, I need the gold, but I'm going to pay you not tomorrow's. I'm going to pay tomorrow's fixed loan in a second, but I'm going to pay you after tomorrow. It's okay with you if I pay you a day later? Yes, I take it because I didn't know money I could cover the check. Right? So next day I give him money. So according to that, you adjust your business, how you buy the gold, from where to buy the gold or diamonds, so you'll be able to cover your check, because you miss one time, that's about it. Nobody will trust you. They're going to say, bring me cash check, or, you know, come here and pay me. I don't want to give it because your check bounced. So I did buy the gold from different people, and, including Rami. As I needed, I could, or the circumstances made me to do it, to go to him or to other. If I had enough money, I'd go buy from UPM, United Precious Metals, or there was other companies, powerful company. They sell the wholesale. They charge me 50 cents an ounce, which is, you know, it's 50, like what, $15 or $12 to $14 instead of paying like $100 for a kilo, $33 for an ounce to buy the gold. So, you know what I mean? It's It always depends. I did, if I bought from him, let's say average 3-4 kilo or 2 kilo gold sometime, it's already in that day's prices. I believe gold was somewhere 450 an ounce, so it's translated to $14,000. So if I buy once 2 kilo gold a month, it's like already number $26,000 to $27,000 business. You know what I'm trying to say? I don't know. I cannot say.
So when did the paperwork get done on that transaction? So how does the paperwork get finished?
You give me gold, you fix the price the day you want to pay on lendings. Nobody wants to gamble with the gold price, right? So we fix it. Let's say I buy the gold today, receive the gold from today from him. And we decided it's going to be loan second payments for Tuesday morning. So that will determine the price of the gold plus his commission or premium, what he wants to put on. And then I give him check. Usually it's, if he deposited that day, or I told him to wait 1 day, whatever. I don't know. In a couple of days he went to bank, and the bank cashed the transaction down. I got the gold, he got the check. That's it. That's all I know.
When did you get the invoice reflecting the details of the transaction?
I tried to get it all the time, but there's no good at it. But I got it. I did. I went to, when I was in office, I said, write it down. Give me the invoices so I can put it with it. I don't know why it's not there. That's what bothers me. If that checks what I found, usually it should be, in my practice, as much as I don't, it should have been like stapled, the invoice copies or something. But I see the stapled, but there's no copies of this invoice.
Who was doing the invoice? Was Rahman doing it, or were you doing the invoice?
If he sells, why should I do it?
But you didn't. Did you get them? You got them late. Did you usually get them late?
I'm telling you, he's not good at this. He's not good at it. Never. He tries to do everything alone. He's not good at that.
When did you ever use cash, currency, greenbacks in the business? Did you ever do this?
Never. I never have a cash business. I never deal with anybody to give me cash. All the jewelry companies, most of them very big ones. Like, we help a lot of huge diamond houses who will supply jewelry to, let's say, Sears, Zell's, that kind of companies. There's nobody pays cash in that business. Everything was old, like, should have had.
When did you ever, what I call settle? Did you ever settle accounts? Did you ever dispute on an amount that's owed, or was it settled? Yeah.
To whom?
With Mr. Cohen.
I always have. He fights for every penny he wants to get. He spent 3 hours to fight you for $10 instead of saving that 3 hours. That's his cat.
Did you search for all your records when I asked you to search for the records of your?
As far as I know, I did my best.
What happened to the records of your jewelry?
Oh, mostly it's you have a lot of boxes. In the year, you have a lot of boxes. You don't store that stuff. And everybody says to me, all including you as a lawyer, you should keep it not more than 7 years. What I was going to do. So what I do at the paper, but where I put it. I don't have a business. Business is closed. Everything is gone. And in the building, I'm not sure when was it, which year, but I had a roof kind of collapse. The water went through and my computer systems and everything went to bed with the paperwork. So then when we moved, the place was listed for other businesses, so it had to be cleared, from this storage to the other storage, then it becomes headache, and I don't have to keep it, so I just throw it away.
When were the records disposed? When were they disposed?
I used to go like, basically, I didn't have anything since 2015, 16. I didn't have anything to it.
Did you maintain inventory? You maintained inventory.
Of course you do.
Where did you keep it? Where did you keep it?
Safe.
This was on Broadway?
Yeah. Vault, actually blindfold. Put it inside, lock it, and show up. Alarm system for everything.
Where were you born?
Virginia, year one.
When did you come to the United States?
So 1979.
You were a U.S. citizen?
Yes, I am.
Does the department have any questions for this witness?
We do not.
Colleagues?
I have no questions. No questions.
All right, I have no questions. Would you like to examine your client?
Yes.
Okay. And if you wouldn't mind, Mr. McGinnis, moving the microphone over. You don't have to move.
I'm very sorry. May I?
If it'll, Mr. Lambert, watch out, but if that'll stretch over there, that's an excellent idea. There you go. And I, based upon what I've observed this morning, I need to be close to the mic. Put your mouth right up to it, 2 inches away from it when you're talking in order for the voice to carry. Mr. McGinnis, you should use the mic also.
Okay. Is it okay if I just sit down where I put the camera?
Yes, it is. Thank you.
Thanks. Sorry.
Could you state your name and address for the record?
Mr. McGinnis, please pull that mic over.
Could you state your name and address for the record?
Ramin Cohen, 706 South Broadway Street, Los Angeles, California, 90014. Ramco Jewerly, Corp.
Could you describe the nature of your business during the years 05 and 10 to 10?
I had a wholesale and retail jewelry business.
Please now, are you familiar with Yerma Jewelry and Haka Pirmad?
Yes. Yes.
What was the nature of your transactions between the petitioner of the corporation, Acapulco, Ramco, and Yerma Jewelry? What were you doing?
I was selling them gold, diamonds, precious stones, and sometimes like finished goods, like finished diamond merchandise.
Where were you born?
I was born in Tehran, Iran.
And where did you get your education?
In Iran.
So what's your principal language?
It's Farsi.
During the years at issue before the court, who did your tax returns and did your accounting?
It was Mr. Wahab Hagai.
Did you ever have any discussions with him about the adequacy of your records and whether you were keeping the type of records necessary to verify the accuracy of your tax returns?
Before, until the day that I was audited, he was doing my taxes since 1992 or 1993, I believe. And during those years, I was giving him all my paperwork, and he was doing my taxes. And until that day, I was thinking like he was doing everything right and everything is okay, till the day that I was audited.
Was this your first audit by the state of California?
Yes.
Did you receive advice from your newer reps that was contrary to the advice that Mr. Hagai gave you? Did you get different advice?
I don't understand the question.
Okay. Do you do business the same way now that you did during the audit
Oh no, like after the audit, because of a lot of discrepancy that we have in the paperwork due to either not having enough time to do it or not giving enough paperwork to my accountant, or also the negligence of him, or not telling me what to do exactly. So now that we're doing it differently.
How did you do your sales tax returns? What happened? Did you take the receipts there and have them did they just run a tape, or what? What did they do?
I was giving him all the receipts and all the paperwork on the bank account, and I was telling him, like, this was the retails and this was the wholesales, and he was going through them and make the assessments on how much sales tax and how much wholesale.
Did you ever have an accounting prepared under any conventional accounting software like QuickBooks or anything like that?
No, I never did.
When was the first time someone advised you to use QuickBooks?
Like a few years ago, a couple of years ago.
Who was this from?
It was you.
Did he ever advise you that one of the most important documents ever prepared by a preparer was reconciling the gross receipts for income tax purposes with the sales report for sales tax purposes? That was an absolutely critical document to have in any case, in any return filing. When was the first time you heard this?
This is a common sense. They have to always match, and I thought my accountant is doing a good job for me.
So when was the first time you actually were doing that? That you know they did that? Okay. When was the first time that your accountant actually did a reconciliation of sales for sales tax purposes and income for income tax purposes?
I was under influence that he was doing it all the time.
And when did you find out he wasn't?
Right after the audit, I realized that he wasn't doing it.
There's how much, if you had to give an accurate estimate of the amount of goods, meaning gold, silver, diamonds, precious stones, platinum, how much did you sell for your jewelry for each of the years, roughly?
I would say probably about 700,000 or 800,000 a year. Maybe a little bit more. I don't know.
Did you ever, what was the typical transaction? How was the size of the purchase and what was the sale? And how did you get an invoice? Did you get a bill of lading? What was the paperwork? During the years 05 to 08, what was your typical paperwork?
A lot of times, I used to sell merchandise or whatever I needed. And sometimes I used to give him right away receipts, or sometimes a couple of days later, the invoices.
You also had other firms you did business with.
Yes.
Would you answer? Keep looking at the microphone, okay? Because
Okay.
you're losing your voice.
Sorry about that.
Were there other firms you did business with during these years?
Yes.
Okay, could you tell the court which they were, particularly the ones who did business with you in cash, meaning greenbacks, paper dollars?
I worked with Creative Diamonds and also AHM company that they were making manufacturing. Also with sometimes Millennium Diamonds.
So now, what was your typical transaction with them and how did they pay you?
They would pay me sometimes cash, and sometimes they would give me check and that I had to cash it before I give them the merchandise.
Why did you do that? Why did you take the
Because
check?
I didn't trust the numbers.
Was one of the companies, who owned Millennium Diamonds?
I believe Mr. Vipul Shah.
How did he pay you?
He would pay me in cash most of the time.
What was the typical transaction?
10,000, 15,000, 8,000.
So did you?
Sometimes I would give him the merchandising parts. I don't give everything at the same time.
And was there another?
Till I get paid for it.
So was that an indication of lack of trust?
Yeah, in this business, I mean, if you lose like a parcel or one deal, it's going to take the whole year profit from you. So you have to be very careful.
Who owned AMH?
I believe Mr. Alex, but I believe he passed away. We tried to find him, but the family told me that he passed away. He was sick.
Was one of the companies owned by an individual who emigrated back to India?
Yeah, it was the Creative Diamonds.
How much did you sell them?
I sold a lot to them, actually. I would say about $1 million a year, 700,000 to $1 million.
And when did you know he was doing this? Did he give you a reseller certificate? Gave you a reseller?
Yes, he did. Yes. He was a diamond company. He was a diamond dealer. He was selling diamonds, buying and selling diamonds.
So was there ever an occasion where you entered into transactions essentially to cover checks you had already written?
Yeah, it happened sometimes that I wrote checks for people, and it happens quite a few times that I didn't have enough money to cover it. So I had to borrow money from other people and make a deposit and then pay them back later. At a later time.
Was it by check or was it by cash?
So some by cash, some by checks.
So was that the source of some of the deposits?
Some of it, yes.
How much, who advised you on the paperwork for doing wholesale transactions? What were you advised of? What were you told you had to do in these years?
I thought I just had to get the resale numbers.
That was it?
That's about it. Resale numbers and where the place of business is. And a few references from other people.
What about invoices? Did they talk about invoices?
Yes.
Did you actually get the reseller certificate? Were you told?
For the people that I worked a lot with, I got them. Maybe I didn't get for every single one of them, but then I realized that at a later time that I need to have for everybody.
What percentage of your business was legitimately wholesale and what percentage was sales to retail?
I could say 85 to 90% wholesale.
And so how did your accountant determine what was a retail sale, a sale in interstate commerce, and wholesale? How were you distinguishing those when you talked to them?
I would just, some of them I would tell him, and some of them would just see it from my bank deposits, and I would tell him that what it was for, and he would do the assessment for the taxes.
Did you both review?
And I would give him also like the invoices and the retail invoices that I had.
So one of the things you mentioned in the decision or recommendation is that you actually produced invoices for wholesale sales that exceeded the amount that was reported on your sales tax return. You know how that happened?
I honestly, I cannot tell. Maybe some of them was, we wrote like a couple of times invoices instead of once. That could be like a duplicate invoices. Or sometimes it's because I did it at a later time, some of the invoices that I sent for the customers, maybe I made a mistake.
what was it, how did you maintain inventory during the years 05 to 2010?
I have some inventory. Yes.
How did you keep it safe?
I would put it in a safe. We have a safe in the shop. I would put it in a safe.
Did you actually make physical inventory? Were you ever advised to do a physical inventory of anything you did?
You know, I've been in business many years, but not really I've done it. Like, so
were you ever asked
to do the
to do a
inventory?
physical inventory?
By whom?
By your account?
No.
Who did you buy the gold? Here's the typical transaction. Yerma decides they want gold, 5 kilos of gold and diamonds. You have to buy it from somebody. Describe the transaction. What happened? Who did you buy it from and how did you resell it?
I bought from some direct importers. I used to buy them. Sometimes I used to get terms from them and then sell it to.
So how much money did you make? How much money did you make on these transactions?
On the gold, really is nothing, because gold, when we buy it, when we buy like 1 kilo gold and we sell it, we probably make, for a large transaction of $15,000 maybe, we would probably make $50 or $100. But on the diamonds, we make more profit. On the diamonds, if we sell, we make probably about between 5 to 8% maybe, sometimes.
So you got two sets of invoices. You got an invoice between you and your supplier, and you have an invoice between you and your, for example, right?
Yes.
When did you review these and organize these for tax purposes?
Like after the audit, some of them.
Was it ever done prior to doing the tax returns?
For my accountant?
Yeah.
I used to just give them to my accountant and explain him, and I was like depending on him to do the accounting and to do my tax return.
Did you ever have any accounting or bookkeeping training when you were in school in Iran?
No.
How far did you go?
12th grade.
Now, we originally, I'm just trying to clear the record, had Mr. Eagleshaw. Now, why did Mr. Eagleshaw not come?
Today was their New Year's, and he was the keeper of the temple. He had to take care of people in the temple, so he apologized and he didn't show up. We tried to have it for a later day, but we couldn't change the date, so he just didn't come.
After the billing order was that the audit was completed, did you try to get the bank statement so you could recreate your account?
Yes, I did, but I wasn't able to get it from the bank. They wouldn't be able to give it to me. I thought whatever accounting that I had, I thought my accountant had it, and that's all the records that I had.
So you hired two CPAs to try to re-audit or recreate the records. Who were they and what happened?
It was Mr. Chabishian and also Mr. Neil Harmon.
Where was Mr. Chabishian?
I really didn't work with him. I worked with Mr. Harmon mostly. He was in the uninsurable, his office.
Could you give me the spelling for that?
Yeah, N-E-I-L Harmon, H-A-R-M-O-N, if I'm not mistaken.
R as A-R-T, last name C-H-E-B-I-S-H-I-M-A. I don't want to testify. I've known Mr. Chabishian for a long time. He was formerly IRS. What did they tell you?
Mr. Harmon did that to a certain amount, and then after that he said because we are missing a lot of bank statements, they couldn't finish the whole thing.
Okay, now you had a retail business, and there were items which were. How did you get to the point where you misreported your retail sales during the audit case? What happened?
as I said, I would just get the receipts of my sales, and I would just give it to my accountant, and excuse me, and I would tell him which one is retail and which one is wholesale, and he would go through them and make the calculation for me.
How long did you use him?
Fortunately, I used him since 1992 till I believe 2012, 13.
When was the first time you realized that there was a problem with what you were doing?
I mean, I didn't know anything until after the audit. I thought everything was fine and I thought I was doing a good job. And after that, I realized that it's a lot of things that is not 100%,
So who is
done right.
Who is your CPA now?
My CPA now is Mr. Budai.
Where is he?
He's on Vegetable also.
Would you spell his name too, please?
Boudai, I believe.
Thank you.
Describe a typical transaction you have with Loryn and Jewerly. What happens? Who called who? And how did you get the? Did you have this stuff in inventory, or did you have to scramble for it? What happened? What happens?
Some of the diamonds and color stones I had in the stock, and like if you needed diamond or if you needed color stone for making jewelry, he would ask me. He would come to my shop, and I would he would take whatever that he needed. And in case of gold, I didn't keep gold because it's very expensive. So sometimes when he needed it, I was getting it from gold dealers and give it to him. So that was the.
So where was it kept in your office?
In my safe.
How big was the safe?
Probably half of the whiteboard over there.
Who paid you largely in cash, and were these wholesale transactions? Who was paying you in cash?
As I said, I was getting cash from Creative Diamonds, sometimes from Millennium, and sometimes from Asian.
How do you know that those were all wholesale? Did you have a discussion with them before the order went through that it was wholesale?
Yeah, because they do manufacturing, and also they were like diamond dealers. Their office was in the buildings. They didn't even have a store or a storefront. So they were selling diamonds to other jewelry stores. So that's how I knew they were doing wholesale.
Okay, so
and also I got the recent number from them, and they told me that it's for resale.
Occasionally, or did they tell you that on every transaction?
Well, I didn't ask him every single time, but they were doing it. They were doing wholesale, so I assumed they were using it for wholesale jewelry.
So, what was a typical transaction involving?
They used to come and tell me. They look at the diamonds, or they tell me what kind of diamonds they need, or what size, or how many millimeter for making goods or for their customers, and they used to come and get it from me and give it to them.
Would they bring the cash with them?
They bring the cash or they bring the check. Yes.
And so who produced the invoice? When was the invoice produced?
A lot of times when they come, I was busy because I was short-handed. I tried to do everything myself in my business most of the time. So I didn't have a bookkeeper, in-house bookkeeper to do all my bookkeeping. And I try to do it the best I can. Sometimes I do it a few days later, or sometimes I used to send them the invoices at a later time. But I was the person who was doing that.
So is it fair to say you could have forgotten to do the invoice?
Yes, definitely.
Did you ever sell product on consignment to a retail outlet? Did you have consignment sales?
No, not really. You have to pay for it.
How did you decide what did you typically have for sale in your office? And where was it? Where was your office?
At 706 South Broadway Street.
What did you have for sale? What was it? A store? Did you have a cat counter?
Yeah, what is it? I had the store. And I was, I had different type of stuff. I had rings, I had bracelets, I had necklaces, chains.
How much did you have for sale, and how often did you make a retail sale?
I mean, it's a store, whoever comes in and it was a storefront. They come to my shop, they look at the stuff, if they like it, we sell it to them, to the public. But mostly I put my time and effort on the wholesale. Because there were like a lot of jewelry stores right next to each other, and it was very hard to make a sale with profit. So most of the time the customers come, either I didn't pay too much attention to them, or I just spent time with them a little bit, and if they buy it, they buy it, they don't buy it. I really didn't care.
So, you've signed the sales tax returns. Do you believe that the amount of what's claimed on the sales tax returns for wholesale sales is accurate or close to it?
The one I think is very close to it. I'm not saying it's 100% accurate. I admit that my paperwork was not complete and wasn't accurate at 100% at all times. And I learned my lesson like after the audit, and I realized that my accountant was not doing a good job, and I wasn't doing a good job at the same time. And hopefully in future I'm gonna be a better keeper of records and doing better with my accountant and with my tax returns.
How did you sell? I'm going to describe the transactions which were classified by the government as sales in interstate commerce. How did that happen?
I had some merchandise that I used to ship for customers to another state, and like other state sales. They used to come to my shop, they look at my shop, they used to go to their city and order me over the phone, and then I used to ship it to them.
Okay, so would you state your testimony, would your testimony be that the amounts claimed as wholesale sales on your tax return was accurate, but for the fact that your record being lousy? Is that?
That's correct. To my knowledge, it was accurate at that time.
How much discussion did you have with your preparer when you did these returns? Did you actually look at the numbers?
Sometimes, like very briefly, like maybe half an hour, 20 minutes, half an hour, I used to go to his office to finalize everything.
When was the first time someone stated that you had to match reseller certificates with invoices to and from? When did you first hear this?
I mean, I knew that. I knew that I have to match it, and I have to get people's reseller. And I took it, as much as I could.
So did you bring these records to your account even though you didn't have that done? In other words, you weren't doing that, is that right?
Yes.
You brought those to the accountant with that?
Yes.
What, did he say anything?
He didn't say anything.
Mr. Yermolian produced some receipts, which is marked as petitioner's 10. Do you recognize under any of those transactions?
I did a lot of transactions with Mr. Yermolian, I'm sure of that. And we did a lot of business together. But since I don't have the records and the checks that I deposited in my accounts, I'm sure those are the checks that I deposited in my accounts. But I don't have anything to show the court that collaborate that. But that's the reason I asked Mr. Yermolian to bring whatever proof that he has or whatever he can find for me. And he did the favor of looking into his stuff, and he found those for me in order to bring for the court.
Did you ever cash a check from the jewelry?
What do you mean cash?
Cash it, convert it to currency.
You're going to go to the bank and get money? Never.
So
there's no reason for me to do that.
Was the source of the cash deposits largely Millennium, AMH?
AMH, Creative Diamonds, Millennium sometimes.
So is your testimony that those were largely wholesale transactions?
Yes, they were.
What was a typical transaction with those?
There were different amounts, sometimes like 10,000, 8,000, 15,000, 12,000.
So do you...
Sometimes even more, sometimes less, depending on what they buy from.
Does the issue of trust that was described by Mr. Gamad hold true?
I mean, yes, but the business area right here, I never had an issue with him because I knew him for a while.
Yeah, but in other words, did you do business with people you didn't trust?
I try not to, no. Until I was 100% sure I get paid for it before I release the merchandise.
Were you ever stiffed?
Yes.
Large amounts?
Some, yeah.
Can you estimate each year, the average year, of the amount of wholesale transactions? We'll start with Millennium and then with Creative Diamonds.
Top of my head, I would say maybe close to what I did with Mr. Video and Jewerly. Maybe like 600,000-700,000 each one, maybe more or less. Could be more. Because jewelry is very expensive. Like one transaction, 15,000, 10,000. You do 4 or 5 of them a month, or 1 or 2 every week. You know, it's going to be a lot of transactions.
Does the department have any questions for the witness?
No.
Judge Cho, question?
No.
Judge Gass? No questions. I have a question about original resale certificates. Did you bring them? Original resale certificates. Remember, it was in the order that any resale certificates that the appellant intended to rely upon, the originals should be produced at the hearing. Did you bring any?
No, Your Honor.
Is the department prepared to give actually, you should be argument if you're ready.
We obtain copies of the resale certificates.
I'm not interested in it's time to give you did not bring original resale certificates with you, is that correct?
No.
Okay, the discussion's over about resale certificates. Are you ready to give your closing argument, your initial closing argument?
Yes.
You may begin.
The transaction in question here relates to a portion of the code which states that if the taxpayer doesn't get the resale certificate at the time of the sale, he has to prove that there was no intervening use or that the purchaser did not use it, consume it in his own business. At least with respect to the Yerma jewelry, we think we proved with the testimony of Mr. Kamagin that anything that was sold by Yerma jewelry, by the petitioner to Yerma was consumed almost immediately in production and creation of jewelry. There was no intervening use, there was no personal use, and that any tax that was generated was already paid through a different source to the state of California. That some of this, particularly beyond Yerma jewelry, really relates to the credibility of the taxpayer and whether you see him as credible. Now, I would like to analogize, there are several items in the federal tax code which require contemporaneous evidence, the most important of which is Section 274. If you don't produce a contemporaneous document on travel expense, a meals expense, the code says you don't get the deduction. But the U.S. Tax Court has held for 25 years that if the trier of fact believes that the taxpayer has substantiated the purpose of those 4 or 5 elements through a combination of testimony and records,
that a trier of fact can give him a deduction in the face of the fact that he didn't have a contemporaneous diary or a document. There's many cases on that point. I believe that the court should use the same rationale here. You have a busy taxpayer who has a business, he's trying to wear 7 or 8 different hats. He doesn't get the invoices done, and he's not an accountant. So things get put off and they're not done. But that doesn't change the fact that he tried in good faith to operate. There is a doctrine, and it's been used by the state for years, is that if it's his first audit, you give him a break, because he didn't know. He's not from this country, he's from Iran. And this isn't something he would know offhand. He's had no booking or accounting training. And given the amounts here, I don't think a 94% disallowance is really fair, which is what's happened here. We've got the total wholesale sales were multiplied times 4%, and that was arrived at because the auditor found checks for $34,850 in the first quarter of 2007. I think a lot fairer resolution would be a significantly higher percentage of those, bearing in mind, we would find tax court cases saying, bear in mind against the taxpayer that the imprecision was of his own creation to some extent. I think a lot fairer result here would be that you split the difference, give them half. Because some of the stuff, I mean, I think Mr. Yermagian is a completely credible witness. He was buying a lot of merchandise, and he found those stubs which bore out and corroborated his own testimony. Did the taxpayer screw up? Of course he did. I'm not trying to excuse it. But I found with foreigners, particularly foreigners in the Middle East, they don't necessarily expect the same things because the country they came from isn't the United States. Iran is a totalitarian government. So this isn't something he would know offhand. He would rely upon his accountant. Now, as far as the negligence penalty is concerned, he has no accounting training. This was his first audit. When advised, he tried to reconstruct the records. He hired a different accountant, and he's fixed the problems that have been identified here. Remedial efforts to cure a problem that's recognized and pointed out is evidence that your failure to live up to the code was not in bad faith. You didn't say, in bad faith, I'm not going to comply with the code. It's evidence you didn't know. And that completes my summation.
Did you have an opportunity to respond that to the argument? Mr. Lambert, will you be making the argument?
I will.
Okay, proceed.
Thank you. In this particular case, as has been described, the taxpayer operated a retail jewelry store located in the jewelry district of Los Angeles. The appellant reported total sales on their sales and use tax returns of just under $17 million. Of that amount, they claimed $16,500,000 as both either interstate commerce or resales. That left reported taxable sales of $443,000. So, upon audit, the appellant provided income tax returns for 2005, 2006, and 2007. They had some bank statements, and that was essentially their records. And that's what we had to use in order to conduct the audit. Ultimately, what we found out was that the amounts that were deposited into the bank account matched both the income tax returns and the sales and use tax returns. So we used that information in order to establish the tax liability. We were able to confirm
confirmed that there were interstate commerce sales, that they had made sales to people and had it delivered outside the state of California, which would be not subject to tax. They had one shipper. It was G4S International Logics, and we were able to go through and obtain all the shipping documents from them, and we were able to determine that $1.572 million was in fact shipped out of the state, and we allowed that as not being subject to tax. The remainder, we considered everything subject to tax. The accountant had told us that the appellant either charged tax or they had a tax-included price that they sold to their customer, which it isn't always common, but it's not uncommon. It happens sometimes. And so you would sell something to somebody for $1,000 and you would just say it's a tax-included amount. So they wouldn't list the sales tax separately. It would just be a one lump sum figure, which you're allowed to do. After the audit was completed, the appellant came back and provided us with some resale certificates. There were a number of those. And they also provided us with sales invoices. So we were able to go through those and add all of that up. And in addition to that, we were able to get their bank deposits, and we were able to determine that there were some customers that there were sales for resale and we could identify them. And that was, I believe, about $35,000. We also sent out what's called, we call them XYZ letters. Basically what it is the appellant would send out a letter to their customers asking for information in regards to whether the sale has, whether the customer resold the items. And from that, we were able to determine that there was one transaction of about $27,000 that was also a resale. So combined, we accepted resales of $62,000, and then the interstate commerce of $1.572. So what's important here is that on the return itself, total sales were reported of $1.5 million, resales were $1.478, and they reported taxable sales of $37,000. But on the invoices that they provided to us, they had total sales of $2.53 million and resales of $2.3 million, which left taxable sales of $232,000. So the sales invoices that they provided us were over $1 million higher than what they had reported on their returns. And so we were able to go through and look at the bank statements and reconcile those to the taxable sales that were reported, and they matched. So essentially what you have here is an extra $1 million in sales that we can't account for. So ultimately our decision was we could not rely upon the sales invoices that were provided. One, there were no invoices on the sales, there were no numbers on the sales invoices. We were unable to contact other than one customer on the resale certificates to obtain verification that in fact there were sales for resale. And I would point out the one testimony here, and I know there hasn't been a ruling yet on the admissibility of the documents for Jewerly, but I'll just make a comment that we went through the first quarter of 2007, which was the test period, and there were no deposits into the bank account from Yerma Jewelry because we had the deposit slips. And I'm not saying that the information that's provided here is for 2005. It's not for the first quarter of 2007, and that's why our argument was this is irrelevant to the liability here, is because the liability wasn't established from this period. But I would point out from the testimony is that the witness stated that they pay all purchases from Acapulco with a check. And what I can say is there were no checks in the bank accounts that we had that were from Yerma Jewelry. So if there were any sales during that time period of the first quarter 2007, they were deposited in another bank account. And that's really the issue that comes down here, is that it's not so much that we're not accepting these resale certificates, it's the fact that we can't verify the sales that are being made, or which one of those sales have been reported on the sales and use tax returns. We have no idea what sales, other than we know that the amounts from the bank statements tie out to the returns, but the majority of the information that we're missing is cash sales, and we don't know where that cash goes to. So which one of those transactions, or quite frankly, what other sales there were that cash came from that are subject to tax, that aren't showing up as invoices, and that's the problem that we have here. So the department found the sales invoices to be unreliable and should not be verified and should not be used to verify the claim to resales. Also, we did not consider the resale certificates in and of themselves because we could not verify the sales invoices that were provided to us. We allowed what information that we had that we could verify in the deposits were in fact resales. So, and I'll just go into resales just a little bit, but essentially, if you have a true sale for resale, it doesn't matter whether you obtain a timely resale certificate or not. We will allow that sale for resale if it can be proved that it was made to that person and they in fact resold it. So when it comes down to a problem is if you didn't obtain a resale certificate and it turns out to be a taxable transaction, the seller is going to be the one that's responsible for the tax. The issue that we have here isn't so much the resale itself, is the fact that we can't tie any particular of those sales into the bank deposits which were used to report the sales or appeared to have reported the sales. I'd also point out for, I don't want to give you the, I'll give you some combinations of two customers. One is Creative Diamond and the other one is AMH Wholesale. For 2007, the invoices that were provided to us was a little over $2.5 million. Those two customers for the year 2007 only reported $1.5 million. So the invoices the sales invoices that we have for 2007 that the appellant has provided to us is over $1 million higher than what those customers reported to us on their sales and use tax returns as sales. So that's the facts, and so I'll leave it as that.
Before you move on,
Yeah.
you said that the sales for both in 2007 totaled a little over 2.5 million.
Yes.
But they reported what?
It was just I'm sorry, 1.5 million, 1.55 million.
Fine.
Yes.
Thank you.
Is that about right, 1.55, the sales invoices added up to about 2.55, somewhere in that area. The location that the appellant had was on the ground floor in the largest jewelry district in the U.S. On the appellant's website, it states, and they've been in business since 1994, and this is a quote, preferred retailer in downtown Los Angeles, specializing in diamond and genuine gemstones, 14 and 18 karat quality, top of the line, white and yellow gold, even platinum. There's no indication that the taxpayer was in the business of making resales. In regards to the negligence penalty, a 10% negligence penalty was applied in this audit. The appellant did not have a prior audit. The fact that the taxpayer did not have a prior audit, we do take that into account. And if it turns out that there was in fact negligence, we will put the 10% penalty. That's what we did in this case. The amount of the liability is significant. We've disallowed over $14 million in claimed resales. The lack of records that were available, and then when the records were provided for just one quarter, they had reported, or they had on the invoices $233,000, and they had only reported $37,000. That's a significant difference just in and of itself. The fact that you would use an accountant to prepare the returns, you're still responsible for that accountant. If that accountant was negligent in preparing the returns, that negligence falls upon you. There was a subsequent audit of the taxpayer, as they had mentioned, and there continues to be issues with the records. I believe that concludes my presentation.
Do my colleagues have any questions?
Hopefully just a quick one. For the test period, were there any invoices for Yerma jewelry?
Not that I'm aware of. No, that we do have in the, and you're going from my memory, but I remember this, in the working papers, there is a list of all, I believe there's several different, maybe 3 different customers, and it lists all of those transactions, and I think that's the majority of them. So off the top of my head, I would say I don't recall any, but I would refer to the audit schedules for, that they would be more complete.
And so the reason why the department's not accepting the sales invoices for Creative and DMH is just because you're unable to verify whether these invoices are in fact the true invoices for that property. Is that what you're saying?
Well, there's two reasons. That's one of the reasons. And the second one is, even if it was possible, we can't tell if it was either, the sale was either reported on the sales tax return or the money was deposited into the bank.
Will we be heard on this?
You have a rebuttal, remember?
We can't determine that from the information that's been provided to us.
So the reason I'm asking is just the audit manual states where when you're talking about a resale, in fact, if you can determine that there are certain sales made to certain customers, or repeating that, and then make a deduction that these are the sales in fact, then it's claims non-taxable sales should be allowed. But in this case, the department's unable to verify that these sales invoices are accurate and that the tidings of the department.
That's correct. That's basically correct. I mean, there are some examples where we say, the business was closed out in 2004, and so we wouldn't allow sales after that point. But the majority of, at least on those resale certificates, the customers appear to be in the business of the jewelry business, which would be, if they're buying either jewelry or the parts to it, would be a sale for resale. They wouldn't be using that themselves. And so it really comes down to what we've said is that if we were able to confirm that the sale took place and it was deposited into the bank account, that would be a different issue.
And then, if you don't mind, comments. I know you briefly touched on it during your testimony, but can you explain again why you have sales invoices that are much higher than the reported amounts?
I think Mr. Cohen testified that he relied upon his accountant to prepare the returns. He didn't do the summary himself. He was bring them over every quarter, and he would have the returns prepared. He's not by training the bookkeeper and accountant, so wouldn't know that. But I'd like to respond to one of the questions you raised. The two people we're talking about here with those invoices, one of them is dead, and the other one is born in India and can't be located. We tried to find both of them. One of them is deceased, and the other is in India and is old. So those were legitimate transactions.
Can I just ask you a quick question? Where did those invoices come from?
I think that I asked Mr. Cohen to produce all the invoices because we were asked to produce them. I brought them and I delivered them to, I think it was a hearing officer in Norway. I had 2 boxes of them. I said, just empty out the entire, whatever organization you have, just produce the invoices. Because the government had asked for them. So we pursued that request, we produced it. I looked through them and they were not organized. I mean, I like that we get to the point where we don't see dragons here when there's no dragons. I mean, he's a lousy bookkeeper, he's not trained to be a bookkeeper, and he didn't really know.
Thank you.
Did you want to take a minute to talk to Mr. Yamagi, who is apparently desperate to talk to you before you give the final closing?
Okay, can I have a minute?
Sure.
Mr. Yamagi is telling me that there were possibilities when they would have a sale. And they would
Wait a minute. Testimony's over.
Okay.
Are you ready? Before you give your final closing, I'm going to admit your Exhibit 10. You were here earlier for the prior hearings. Strict rules of evidence do not apply to the admission of evidence in our proceedings. I'm going to admit it, and the judges will decide how much weight to give to it, okay? So that's Exhibit 10 is admitted. Are you ready to give your final closing? Because
yes,
if you are, I want to just ask you a question. It sounded to me like you were making an argument earlier based on a case that said that if it appears from the evidence that a taxpayer is entitled to relief, but is unable to prove the exact amount of relief that the taxpayer is entitled to, a judge or judges can grant some relief weighing against the taxpayer the fact that it's the taxpayer who's failed to prove the specific amount that they're entitled to. Is that what the argument you were making earlier?
Yes, sir.
Okay. With that, if you've got your 5 minutes, you can begin when you're ready.
The Board of Equalization position here boils down to a 94% disallowance of claim. The Board of Equalization position here ends up with a 94% disallowance because they scheduled the first quarter of 07 and they have 34,000 in checks, and they knock out 94% of the wholesale sales, even though they have invoices from one of them to have $1 million. I say that, I contend as their representative, that is patently unreasonable. That's not a friendly auditor. That's an auditor trying to screw a taxpayer. This taxpayer is not an accountant. He was trying to run a business, and did he make mistakes? Of course he did, but I can assure you he was tried his best. Some things are in the closing statement of the opposition, which we object to. Number one, the references to the later audit, we've never talked about the audit. It's not relevant. Particularly, he was testifying about records in the later audit, which is whatever. There was no testimony on that. And the two people we were talking about, he couldn't find. One of them is dead, and the other's in India, and we can't find him. So that was the reason why they couldn't verify anything, because he was gone. The court is the trier of fact. They're the judges of whether someone's telling the truth or not. And when I was in the IRS Chief Counsel, our goal was we make them pay the right tax, nothing more, nothing less, but bearing in mind sometimes the taxpayer deserves a break. And that's how we operated when I was in IRS Chief Counsel. And I submit that this court should use the same standard. If it is clear that there were wholesale sales which have not been given credit, you as a trier of fact should give them a break and find that those should be wholesale sales. 94% flies in the face of what I think is credible testimony by Mr. Yermagian and the taxpayer. I believe Mr. Yermagian is credible. He was a businessman. He was not connected to Ramco or Acapulco. These were commercial transactions. And with that, we conclude.
Before you conclude, do you have a number that you are suggesting to the three of us?
Split the difference. Give them half.
What authority are you thinking of for the judges to be able to estimate?
I can get you a brief in a week of hundreds of cases in the tax court where you're allowed as a trier of fact to estimate based on credible testimony. Hundreds of them.
The Cohen rule? The Cohen rule?
Yeah. Okay. It's the Cohen rule. In other words, you're the trier of fact, find a person credible, you have the right to do justice. That's why we came to the court for justice. And that's really your function. I mean, did the guy make a mistake? Of course he did. He screwed up, and I've not many bones about that. I know he screwed up. A lot of stuff was never done. Should he pay for it? We know he's going to pay for it. But he shouldn't pay 94%. That's not fair.
Okay. Thank you. This concludes the evidentiary phase. We've received all the evidence, written the testimony, and the record is closed now. My colleagues and I will deliberate the issues, and within 100 days of today's date, we will issue a written opinion, and a copy of the opinion will be sent to the parties. And that concludes today's proceedings. Thank you all for coming. And we can go off the record.